increase the pace looks like. So is it going to be roughly that 25 basis points per quarter pace like we saw last cycle, or could we actually see something a little bit more aggressive, whether that's back-to-back meetings, or potentially, as there's been some rumblings, even a 50 basis point move coming out of the gate?
Question I've asked a couple times this week, let me rephrase it to you. It's simple. Why can't they come out and say, we're in a pandemic, we have massive uncertainty, including the diplomatic events in Geneva. We're going to go 25 beeps and then sit. Why can't they say that?
So I think when you step back and you look at the overall state of the economy, so even as we're in a pandemic, we're still seeing an extraordinarily strong picture. So labor markets are quite solid right now. So of course, unemployment already below 4%. And I think when we look at where policy is, it's still exceptionally accommodative. And it's hard to sit when you have 7% CPI numbers. It's hard for the Fed to stand idly by. The optics on that don't look good.
The optics on that don't look good. The reality of it is actually incredibly nuanced, as George Saravelos of Deutsche Bank, as Tom was mentioning earlier, talked about in his note this morning. This idea that the inflation that we're seeing could be contractionary in its own right, that if the Fed doesn't act, that actually the economy will slow much more than people are certainly expecting later on. How much are you seeing people not spend because they are concerned about how high prices have gone?
So I think we've certainly seen that in some of the buying plans for some big ticket purchases. So if you look at the Michigan survey, you've seen the buying plans for homes, autos, large household durables have absolutely cratered. And when you dig into the reasons for that, it's not so much households being worried about their home finances. It's just the sheer price. And so I think we are seeing this inflation cannibalize some of those sales. And I think it is one of the factors that's leading us to expect a much more trend-like pace of consumer spending this year, which is going to offer some relief on the inflation picture. But it's going to be more towards the back half of the year. And even then, I think we're still looking at an environment of inflation well above where the Fed wants it to be.
And meanwhile, the nature of this inflation is becoming more politically perilous, with the lowest income or workers who originally enjoyed the biggest wage gains starting to see theirs fall behind on a percentage basis relative to the highest earners. You're seeing, so for example, bank employees with massive gains in their salaries. How much does this change the narrative in a significant way and push the Fed to move faster? Because right now we are back in a scenario where the top brackets are benefiting the most.
Right. So I think this is an important element. So we focused a lot on the labor market being broader and more inclusive over the last cycle. But I think when we look at the current environment and the current state of inflation, so grocery store prices rising the most in 13 years, same as energy, housing costs, when you factor in those utilities, also up, by the most we've seen since the early 1990s, this disproportionately affects your lower income households. And so I think there is something to be said for the Fed tackling this inflation, making sure that it doesn't become entrenched where they have to tighten policy even further down the road. That actually has disproportionate benefits to lower income households that don't have as much room to hedge around these higher prices. They don't have the savings to dip in to the same extent as higher income households as well.
Okay, let's go back to the great John Sylvia, who developed Wells Fargo, and you people have continued it forward, Sarah House. What do real wages do? And I don't mean so much the real wage, but what does the real paycheck do here? The inflation-adjusted paycheck.
Right. So in terms of real average hourly earnings, so we've seen them turn deeply negative over the past year. Now, I think we'll see some improvement in that dynamic as the year moves forward. So we're expecting stronger wage growth as we do see the labor market continuing to tighten, and businesses have come around to the fact that if they want to attract and retain workers, they have to pay up. That was a lesson that was hard to learn the past cycle.
Okay, but Sarah, go away from hourly wages. You sound like an economist.
Sure.
Go to somebody that's a house. Somebody's making 140, the other person's making 120 or 90 or 180, whatever. But bundled all in, they're doing a tax form of 150 or 200,000. That's not an average hourly wage, but they're getting clobbered by inflation. Are they going to be able to keep up that upper middle class household that everyone aspires to? Are they going to be able to keep up in the next 24 months? I don't see it.
I think the picture is actually going to look better when we talk about some of these stronger wage gains, not just in those lower income, high contact service sectors like leisure and hospitality that we've seen, as we do see wage pressures filter up into higher paying brackets as well. And then the fact that we are expecting inflation to recede over the course of that year. So that balance is going to get a little bit better. And I think when we talk about overall household income, we have to remember that we're also adding a lot of jobs this year. And so that's going to help in terms of that aggregate wage and salary income. That's going to help offset some of these inflationary pressures that households are seeing is as we see more people step back into the labor market and you go back to more two-income households.
Sarah, before we let you go, the Fed is increasingly moving to a data dependency, as they keep saying, and as a lot of people in the market seem to believe. The question is, which data? So what is the most important data that you're watching in the weeks and months to come?
I think near term, it boils down to inflation. So we are under the assumption that employment's going to hit an air pocket here in January and February with Omicron, staffing absences, difficulty staffing up and bringing on new workers. But I think it really comes down to how quickly or whether at all we do see those inflation pressures begin to recede. So we expect inflation on a year-over-year basis to top out here in the first quarter. But on a monthly basis, we're still going to be seeing some pretty strong gains here in the near term. And so I think it's a matter of how much some of those monthly gains come down. If we're still seeing, 0.4% monthly increases, I think that's still going to keep the pressure very much on the Fed to signal that they are closely tracking inflation and trying to rein that in before it becomes too entrenched.
Sarah House of Wells Fargo. Sarah, thank you. Called 7% inflation to start the year. That's what we got. Looking to average that and then maybe peak at the end of Q1. I was just catching up with Larry McDonald, Tom, over the Bloomberg,
yes.
just reminding me of the sequencing of the Federal Reserve and the timeline last time around. I think it's important to go back over. Remember, they flagged the taper back in 2013. Everybody remembers that. Then the hikes didn't start until 2015, Tom. QT didn't really start until 2017. And this time around, they're going to do it all in the space of not several years, a few months.
That's the plan. Who says that's going to actually be what happens?
Can they execute it? And do financial conditions,
or are
Tom,
they going to be overcome by events?
One of those events might be a tightening of financial conditions before they're even able to hike. Lisa, that interest rate hike that everyone's expecting, I say everyone, most people, is in March. Equities are already down 10% on the NASDAQ.
This is such a different time because of inflation. And this is what a lot of people are looking at. In fact, you have some people saying, should the Fed not only not back away from a market correction or a market disruption, but aim for one, because that is the transmission mechanism of their policy. At a certain point, if you actually are dealing with inflation and you're not just trying to normalize for the sake of it for more ammunition next cycle, that changes the game, John.
That's why I think, Lisa, it's almost impossible to say with any confidence or conviction that we've discounted all of this in this market, because so much of it is so unpredictable.
I would agree with that. I mean, what are we even discounting, right? What sort of policy progression and what reaction in markets? And there's so many nuances, especially at a time when the data seems to be moving so quickly.
Well, how do you discount the prospect, Tom, of $1.5 trillion of balance sheet reduction going into the end of next year? I'm not even sure how you do that.
No. Everyone is not sure how to do this, John. We are, it's a cliche, but it's true. This is original territory. John, have we quoted gold today?
Would you like to?
I would like to quote gold because you'll never find your gold on a sandy beach.
Oh, right.
You'll never drill for oil on a city street.
TK,
1836 an ounce in honor of the meat.
I thought you'd go with the big tech story and say the sirens are screaming and the fires are howling way down in the valley tonight.
Oh, boy.
Doesn't that make more sense for big tech?
My word.
My God. Karaoke this morning.
Silicon Valley. And come on. Futures down on the NASDAQ, down 0.75% from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Bitcoin fell today to the lowest level in more than 5 months. The world's largest cryptocurrency dropped below $40,000. It hit a high of almost $69,000 back in November. Other cryptos fell too. Virtual coins have become a symbol of the retreat and speculative investment sparked by the prospect of tighter monetary policy. Now, China is quietly urging banks to increase lending after a slow start to the year. Bloomberg's learned that the PBOC has given so-called window guidance to large state-owned lenders and regional banks. It is urging them to extend more credit to companies and households. Bank lending in the first 2 weeks of the year was lower than a year ago. Hong Kong status as a magnet for international financiers is falling apart. Headhunters trying to fill jobs say they can only recruit bankers and traders who already live there. There is a growing outflow of expats who are frustrated with the city's strict COVID-0 policies. The American Chamber of Commerce says 44% of those who respond to a survey said they are likely to leave Hong Kong. Bloomberg has learned that Intel plans to build what it expects to be the world's biggest silicon manufacturing site. The company will spend $20 billion on the chip-making hub near Columbus, Ohio. Intel CEO Pat Gensler tells Time magazine the company will use the new facility to research, develop, and manufacture its most advanced chips. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the tests strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
average rates of immunization in this country. We're still not at 2/3 of vaccination coverage. The loss on the jobs mandate and the workplace safety for employers over 100 employees is a real loss because it's going to prolong the pain. And so that's still our biggest vulnerability.
Dr. Chris Barrow there of the Johns Hopkins Bloomberg School of Public Health. With equity futures this morning down about 20 on the S&P, we are negative 0.4% on the Nasdaq 100, down 127, and negative 8 or 0.9%. Unlike in previous weeks, where risk assets have been shaped by the bond market seems to be shaped by what's happening in risk assets. Yields lower yesterday, again today, down a basis point on 10s, a break of 180, 179. That's the price action. We're just hearing from reports, Tom, that the talks between Secretary Blinken and his Russian counterpart, Sergei Lavrov, have wrapped up in Geneva. The path forward from here at the top of the hour, we're told 7 a.m. Eastern time, so in about 12 minutes' time, Tom, we'll have a separate news conference with Sergei Lavrov. Then Secretary Blinken will speak 30 minutes later. That's the state of play as we understand things so far. Tom, of course, in the next 10 minutes, things could change.
No, the distance from the two hotels is the distance that the discussion seems to be. Maria Tadeo making very clear, John. The goal here is really not to have an agreement, is it? It is just to hear each other out.
I would say the ideal situation, Tom, would be a joint news conference, not a separate one with 30 minutes apart. That would be the ideal situation, but nothing about this right now is ideal, is it?
We'll see, and we'll bring that to you worldwide. We'll be, of course, looking at the headlines, and we're deciding what we can do to look in on two of these important discussions. Right now, for at least everyone in America and a tumultuous United Kingdom and all, the conversation is we all go to Omicron this weekend. Andrew Pekos joins us, Johns Hopkins Bloomberg School of Public Health. Andy, I've got to cut to the headline news that I see some form of 7 or 14-day moving average of deaths over 2,000. It's a big number. It's not 1,900, it's 2,000. What do 2,000 deaths signal to you?
Well, this is a major shift in terms of how the variants have been causing disease. We're seeing Omicron being less severe, but because it's so transmissible, it's increasing case numbers, and therefore that slightly lower severity rate is being sort of trumped by the fact that the case numbers are just expanding so high. Now, we're seeing case numbers drop, but it's important to remember that the hospitalizations and the deaths oftentimes lag case numbers by anywhere up to 2 weeks because it takes longer to develop that severe disease.
Dr. Pekos, this from the Post in this morning, and there's any other numbers, we want to get your perspective. Unvaccinated 65 or older are 49 times more likely to be hospitalized. How many of those 2,000 deaths were unvaccinated people versus vaccinated?
The vast majority, and it ranges from anywhere from 75% to 90% based on the numbers that I'm seeing. So unvaccinated people are still driving that severe disease.
Do we need to do what Austria does? I mean, Austria overnight said get vaccinated, right?
Well, this is the ongoing issue here in the U.S., and I'll tell you, it's also going to come into play when we start to see these case numbers continue to drop and where we're going to plateau. So are we going to plateau at a level that's low, say pre-Delta, or are we going to plateau at a level that's high because we still have a large number of people who are unvaccinated? And on top of that, it's also shown now that the boosters are helping prevent infection as well, too. So we're not just talking about vaccinated, we're talking about people who have to be vaccinated and boosted to really get the maximum protection against Omicron.
Meanwhile, over in London, Andy, some of the big banks are saying to their workers, all right, time to get back into the office. I think we're past the peak, and we have to live with this. We've seen that from Goldman Sachs and Citi, now from Barclays and HSBC. Do you think that this is an appropriate policy? Do you think that people should get back to the office? They should go back to using public transportation and start operating as though this is just the norm?
Yeah, it's not about being past the peak. It's being close to the bottom of the peak. That's the critical thing, because historically in other pandemics, there's lots of information showing that if you bring people back too early, you suffer the risk of having a second surge of cases, or again, plateauing at a higher level than you would if you would have just waited a little bit longer. So signs are looking good, but we still have to realize that we're at outrageously high numbers of cases cases in most places, and we still need to hold on and monitor that and minimize that for at least another week or two, perhaps.
So, Andy, what are you looking for to sort of ring the all clear, ring the let's get back to some sort of normalcy?
Yeah, so it's really the slope of the line that's showing us the case numbers, and then when that slope turns to a plateau. If it turns to a plateau at a very high level, then we will still continue to see absences from work and those impacts on the economy that the illnesses are causing right now. So it's really about where this bottoms out, and in terms of measuring the effects on the economy and normal work and school life.
Andy Pekos of the Johns Hopkins Bloomberg School of Public Health. Andy, thank you. Lisa, you saw the same headline that I did. Deutsche Bank looking to bring the staff back in London. That's where the big effort has been this week.
Yeah, and you've seen all of the banks basically saying, look, we can move to a hybrid, but we are past the peak. And at this point, we've got to start getting back to normal. They are going to be wearing face masks. They do have certain vaccine mandates. They still have testing requirements. But when do we say we are back to the new normal? When can we really make that determination when you do have a lot of cases, but they do seem to be not followed by quite as many deaths?
I think some people have already decided with that, Lisa.
Yes.
I think the UK TK is already there.
John, can you bring up some confusion here? Deutsche Bank says they're going back to work in London, and I believe Lisa said with masks. Did the Prime Minister of the United Kingdom say 48 hours ago, forget about masks?
He did end the mask mandate, Tom, although I think he did still say that in some places you'd have to wear them. And ultimately, Tom, it's a private corporation who has to make their own decision about the safety of their employees. You can have the guidance from a government, any respective government, but the private organisation has got to make their own call on it, haven't they?
I guess so. I mean,
and you have noticed, Tom, a lot of corporations have gone the extra step further in terms of testing requirements and vaccine requirements before the government even made the big push here for a vaccine mandate.
Well, clearly in the United States, John, that's the tradition. I mean, you know, we mentioned Austria and some of the Asian countries as well, where there's far more of a government statement. And the history here of medicine, frankly, back over 200 years is for private response.
If you're just tuning in on TV and radio, there has been a meeting this morning with Secretary Blinken and his Russian counterpart, the Russian Foreign Minister, Sergei Lavrov. He is speaking in Geneva right now. He's calling this an interim meeting, Tom. That meeting's just wrapped up, so we're going to have separate news conferences. Sergei Lavrov has gone first, and we'll hear from Secretary Blinken, I understand, Tom, anywhere between now and the next 35 minutes, the next 1 hour.
I just triangulated Moscow, Berlin, and Kiev, and boy, is there a lot of history within that triangle, John.
The most important headline I've seen so far, Tom, Sergei Lavrov, the foreign minister of Russia, saying Secretary Blinken told me he's satisfied with the meeting. I mean, that's some encouraging sign, I guess. We're going to hear from Secretary Blinken a little bit later. Lisa, it's a low bar at the moment.
It's a low bar, but it's also really telling when someone says this before their compatriot speaks at a different hotel location separately a half an hour later.
It's the problem I have with separate news conferences. I think we'd all prefer a joint news conference, Tom.
The three of us met with Al from New Jersey yesterday, and I said I was satisfied with the meeting.
No.
Are you saying you weren't satisfied with the meeting?
It's a freaking disaster.
Futures down 0.7% on the Nasdaq 100 from New York. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
The Fed's history is they break something when they raise rates too much.
As always, the question is what's different this time?
I think we're going to get this realization that the economy isn't quite as good as we thought.
This is a lopsided market with some industries outperforming and some sectors outperforming.
We think that real yields start to rise this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Waiting for Secretary Blinken from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. NASDAQ futures down again, down 96. We're down 0.6%. The foreign minister of Russia right now, Tom, Sergei Lavrov, continues to speak in his news conference.
Wait to the American tape and you really see it in Swiss franc and Euro Swissy is the real measurement of tension within Europe. John, the headlines coming out across the Bloomberg. This is what Bloomberg News does best. Lavrov, Russia isn't planning to attack Ukraine. It seems to be a rote conference. This at the President Wilson Hotel on the shores of Lake Geneva. We go up Rue de France there to the Intercontinental Hotel in one of the nice suburbs to hear Blinken in a bit.
The Russian foreign minister saying, Tom, Russia has never threatened the people of Ukraine. Also saying that Secretary Blinken told him he's satisfied with the meeting. I agree with you. Important to hear from Secretary Blinken in the next 30 minutes or so.
Well, the nuance is there, and then the nuance redounds back to President Biden and the domestic front as well. We're going to cover that today, as well as what we usually cover. But, John, it's just, as you have mentioned earlier, and I think Lisa's mentioned, the compression here of news and the exhaustion of the moment of January 21 is just stunning.
3 weeks into it, we haven't even closed out the third week. It all started, Lisa, in that 2-hour news conference. At some point, the president, in the minds of many, made a strategic error when he said the following. It's one thing if it's a minor incursion and we end up having to fight about what to do and not to do. And the cleanup act of this administration through the next 24 hours has been quite intense.
It's been intense because of the backdrop of inflation and oil, and Russia being a major supplier of oil to Europe, how this factors into the relationship between the U.S. and Europe at such a perilous time with the price of all consumer goods going up so much. John, how much does that tie the hands on a diplomacy level when you are trying to both push forward an economy, or at least let the air out slowly, while also having a hard line with an opponent?
So that's geopolitics. We just said we're not even 3 full weeks into this trading year. I mean, if you've been long the NASDAQ or long Netflix, it feels like you've been trading for 10 years. through the first 3 weeks of this year. Lisa, Netflix down and down hard in the pre-market following earnings after the close yesterday.
How much is this an idiosyncratic story of one of these pandemic plays? Nobody had anything else to do. They were home. They were willing to pay for whatever they could watch on the screen. Now they're not. Now they're not signing up as quickly. How much is this a specific Netflix story, and how much does this indicate that we brought forward so much demand for some of these stay-at-home stocks, and it is not going to continue at the same levels as pre-pandemic for a long time?
I said it earlier, I'll say it again. At the close yesterday, this was a $225 billion name. $225 billion names, Lisa, should not be moving 20% in the pre-market.
And you pointed out, why didn't they guide people a little bit more? Does this undermine faith for some of these shares that have taken on such a massive component of the broad index?
We got a ton to talk about this morning. Let's get to it. Your equity market is lower, negative 0.4% on the S&P. On the Nasdaq 100, down 0.7%. As we talked about a few times already this morning, typically as the year goes, the bond market is shaking up the equity market. This time, the equity market's shaking up the bond market the other way. Yields lower yesterday, again today, down a basis point. On 10s, Lisa, south of 180 at 179.
Yeah, and right now, as you mentioned, we are waiting to hear from Secretary of State Antony Blinken. The expectation is for a 7:30 a.m. Eastern press conference following the meeting with Russian Foreign Minister Sergei Lavrov in Geneva. We already heard from Lavrov basically saying everything was great. It seemed like we heard a lot from Blinken that he was happy with the meeting. Now we hear from Blinken in terms of what the road ahead looks like, what the potential consequences are for Russia should they perhaps tip their toe a little bit more into Ukraine if they're not planning to invade it, as Sergei Lavrov seemed to indicate. At 10 a.m., we get Conference Board U.S. leading index for the month of December. Less interested in the specific components of this data set, more in the overall momentum of the data that we've been coming at. The economic trajectory has been indicated lower. It has been disappointing. How much is this the Omicron bump? How much will it subside? And how much does it really point to a deceleration in an economy where a lot of consumers are worried about how high prices have gone? And at 11:30 a.m., we hear from U.S. Treasury Secretary Janet Yellen. She's speaking at a virtual Davos confab. She said yesterday at a CNBC interview that she expects inflation throughout much of the year to remain above 2%. But if we're successful in controlling the pandemic, I expect inflation to diminish over the course of the year and hopefully to revert to normal levels by the end of the year around 2%. How much does that end up being the story that people look to the new normal of a low inflation kind of environment?
Lisa, thank you. We can talk about this bond market now with Subhadra Rajappa, the head of U.S. rate strategy ex-SocGen. Subhadra, I noticed you published last night. I picked up the quote. The Fed is likely to push back on market pricing of more than 4 hikes for 22 as it prepares to embark on a rapid pace of balance sheet runoffs in the second half. What is rapid to you, Subhadra? How big of a runoff are you looking for?
Well, we got some indication of that from, Fed President Bostic. He said they're looking at, $100 billion per month and a total of a trillion within a year or so. So I think a pace, I would say $1 trillion by the end of 2023 is definitely doable. But that's a pretty rapid pace. There's a lot of sort of moving parts that they have to deal with. They own bills right now. They didn't own bills back then. What are they going to do with the mortgages that are going to pay down? So there's a lot of details to iron, if you will. But I think that they could kind of bring down the balance sheet quite meaningfully over the next year. The consequences are the Treasury is going to have to issue a lot more, to sort of offset the Fed's purchases. So again, there's a lot of moving parts from both the Fed as well as the Treasury when it comes to balance sheet unwinds.
Subhadra, if we shift over the research of the weekend and the research into the end of the month, and the people at 4 rate increases go to 3 rate increases, the people at 3 rate increases tilt toward Englander and 2 rate increases, etc. What does the market do at the margin when we see the marginal rate increase chat adjust?
Well, I think right now a lot of the sort of I would say the pricing lower that you've seen in risky assets has come from a very sharp rise in real yields, as well as the market pricing in a very aggressive path of rate hikes, for this year. I think, more than 4 hikes for this year and balance sheet unwind on top of that seems like a lot for the market to digest. So I think that the Fed's going to take a very, very measured approach to policy normalization. So really, what you're going to see is the Fed kind of talk back the market pricing of rate hikes a little bit, I think, at next week's meeting. because what they want to do is not raise rates too soon and slow down the economy. So again, the key is going to be a very measured approach. They don't really have a lot of clarity on data for this year. The first quarter might turn out to be a very, very slow quarter, just like what we saw back in Q3 after the Delta variant. You could see very much the same thing in Q1 because of the Omicron variant. So, under the circumstances, I think they're going to be very, very cautious when talking about monetary policy and how many hikes they will be able to deliver this year.
I'm really glad you mentioned real yields, basically the inflation-adjusted yield. I'm looking right now, even though nominal 10-year yields are down today, real yields have actually risen to a less negative figure. It's the least negative going back to June of 2020. I'm looking at this and I'm wondering how far it can go. What happens if you continue to see the real yield climb closer to zero, which is pathetic, I know, but still, that we get a zero real yield? What is the consequence of that?
So typically when you talk to asset managers who manage risky assets, either credit or equities, they typically tend to look at that 0 basis points real yield as that point where it's going to start impacting risky assets, broadly speaking. I think policy has been extraordinarily accommodative for the last couple of years. We've had real yields below 1%, negative 1% for a good portion of that time. The sort of rapid rate of change, if you will, or rapid rise in real yields from negative 120 basis points to negative 50 basis points in a very short amount of time has to be a source of concern for how quickly we can get from here to zero. So that's the number I'm really looking at, is when real yields start getting to zero, and what that does to inflation expectations, because we've seen a pretty sharp decline in inflation break-evens. 10-year break-evens have declined quite meaningfully. The 5-year forward 5-year, which the Fed looks at, is at close to 2%, not anywhere near 2.5%. So under the circumstances, the Fed's not going to be really concerned about raising rates too soon, because that's not baked into the expectation. So there's a lot of moving parts here, but I think the rise in yields, real yields, is going to be very important for risky assets.
Subhadra, thank you on this bond market as always. Have a good weekend. Subhadra Japa of SocGen, with 10-year yields in just a little bit today, down a basis point to 179. Over in Geneva, the focus right now on the Russian Foreign Minister, Sergei Lavrov, holding a news conference a little bit later this morning. In about 20 minutes or so, we'll hear from his U.S. counterpart, the Secretary of State, Antony Blinken. At the moment, the headlines as follows, Tom. Allow me to bring a few of them to our audience. Russia isn't planning to attack Ukraine. Ukraine issue needs attention. It's not a cornerstone. The US has promised a written response next week. Putin is always ready for contacts with President Biden. We can't say if we're on the right path or not. Just a few of the comments in the last 10 minutes, Tom.
His first post, and this is a true diplomat, was to Sri Lanka, just because he was the only one in the Russian government who actually knew the language. And then from there, he's built this out. And very critically, John, and I don't have any expertise on this other than to say he's not part of the inner sanctum of Mr. Putin. This guy is a diplomat within the Foreign Service, and there's very mixed reports on him from Western country diplomats. It goes either way, that the guy is challenging, to say the least, to being a nice guy. I'll let others decide, but this guy is a diplomat and doing diplomacy here with the Secretary of State.
Lisa, expecting to hear from Secretary Blinken in about 20 minutes.
I'm curious to see whether he outlines potential consequences, whether he gives a more conciliatory tone, whether he edifies this feeling that he's confident that Russia is not imminently going to invade Ukraine.
The Russian Foreign Minister, Sergei Lavrov, says Russia isn't planning to attack Ukraine. We'll get Secretary Blinken's version of the story in about 20 minutes' time. Futures negative 0.7% on the Nasdaq 100. We're also down 0.7%. Yields coming in too by a single basis point on 10s to 179.36 with Tom Keene and Lisa Abramovich. I'm Jonathan Ferro, on radio, on TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. U.S. Secretary of State Antony Blinken and his Russian counterpart Sergei Lavrov have held security talks in the midst of rising tensions over Ukraine. Blinken told Lavrov the crisis is at a critical moment. Lavrov said the U.S. needed to come up with concrete answers to Russian proposals. President Biden has warned that Moscow could be planning an imminent intervention in Ukraine. Russia does deny that. Now, investors are bracing for the prospect that Netflix is entering a new phase of slower growth. Shares of the streaming giant fell as much as 20% after its forecast for new customers did disappoint. Netflix also said the slowdown will continue for at least another quarter. China is vowing to curb the influence of technology companies. Authorities say they are also ready to root out corruption tied to what they call the disorderly expansion of capital. That is a sign that Beijing may expand a regulatory crackdown that raised more than $1 trillion of market value last year. And the rock superstar known as Meat Loaf has died. His late 70s album Bat Out of Hell had hit songs such as Paradise by the Dashboard Light and 2 out of 3 Ain't Bad. It became one of the best-selling albums in history with more than 40 million copies sold. Meat Loaf was 74 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Of EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is here.
I'm looking at ratios that are jaw-dropping.
Bloomberg is fastest with the numbers and analysis.
I'm going right to return on tangible equity.
They missed on FIC trading. They're too hot. Bloomberg, the fastest numbers and analysis you trust.
Any assembled Russian units move across the Ukrainian border, that is an invasion. But it will be met with severe and coordinated economic response that I've discussed in detail with our allies, as well as laid out very clearly for President Putin. But there is no doubt, let there be no doubt at all, that if Putin makes this choice, Russia will pay a heavy price.
A clear message from the President of the United States from New York City this morning. Good morning with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Your equity market is shaping up as follows. Down 104 on the NASDAQ 100, negative 0.7% on the S&P. We are down 0.5%. This time, yields are a little bit lower by a single basis point on 10s to 178.83 after traveling lower yesterday as well. Sergei Lavrov, the Russian foreign minister, has been delivering a news conference in the last 30 minutes or so. Tom, we still wait for the Secretary of State, Antony Blinken. That is due in about 10 minutes' time.
Let's dovetail this in as Lavrov ends and walks out of the room at the President Wilson Hotel on the shores of Lake Geneva. Anne-Marie Horden, last time I saw her, she was skiing south of Lake Geneva at Mendez, but she joins us now, our Bloomberg Washington correspondent. Anne-Marie, I want to dovetail the domestic Biden in with the foreign policy of the moment. This is Michael Shear and the team at the New York Times this morning. I just thought the way they captured this quote from the president: "The public doesn't want me to be the president's senator," the president said. "They want me to be the president and let the senators be senators." How is he taking this foreign policy moment to be more presidential and less president-senator?
Well, he's taking his foreign policy moment as president. Yesterday was really a cleanup act from his potentially a little bit as a senator, his cadence with reporters when he spent all those years in the Senate, realizing behind the podium, as a president, your words matter. And we saw that over the course of 24 hours, his administration really cleaning up of some insight, which many resonated with for many, given the fact that he said this issue on minor incursions, what that would mean for sanctions, potentially some fighting between the United States and its partners on what that response would be. And as a president, he looked down at a piece of paper yesterday and he categorically explained to the American people and to Moscow and embassies around and capitals around the world about an invasion on Russia, what that would mean, and that would mean sanctions on the Kremlin.
What was Tony Blinken's goal over in Geneva today?
Really, there's no goal for these talks in the sense that going into them, you know they are going to fail. The Russians have set two things that they want, which is, one, Ukraine could never be a part of NATO, and that they want NATO to redraw the map, basically, from 1997, when Boris Yeltsin was meeting with our former president, Mr. Bill Clinton. That is what Russia wants, and that is a non-starter for the United States and NATO members. So going into these talks, the fact that they are talking is really the key objective and the goal here. But it's a tough deliberations. As Tom was saying about Sergei Lavrov, he has been the Russian foreign minister for decades. He's known as Mr. Niet, which means no in Russian. And former Secretary of State Rex Tillerson says you cannot dance with Sergei Lavrov because the man, we cannot tango with him because the man does not dance. So very complicated discussions, and they're both coming in with their hard lines. But the fact that they're talking, for many, is optimistic.
Anne-Marie, give us a sense of how oil factors into these discussions.
Well, there's two things when you look at the oil market. One is that the entire Russian economy is basically enslaved to oil and gas. For years, they have tried to diversify, and they have not been able to do that. On the second nature is, it's a double-edged sword for the West, right? You see oil prices approaching, at least Brent, $90 a barrel. You have inflationary issues already in the United States that is hurting the president domestically. If you were to sanction energy companies or even banks in Russia, you are going to see even a concern of geopolitical concerns. You're going to see a rise in oil prices, and that is going to be very difficult for the United States and other Western countries who are already dealing with higher energy costs.
Anne-Marie, I'd like to get back to the heart of the issue. You came out with 2 points that President Putin would like. Point 1, he would like Ukraine never to be part of NATO. Point 2, he does not want strategic weapons stationed in Ukraine. The President of the United States said in a news conference 2 days ago that they can do something about point 2, they can't do anything about point 1. That's something you said too. But as you know, when it comes to Ukraine joining NATO, let's talk about how likely that actually is, Anne-Marie. It's very, very unlikely. So of course the President of the United States, and for that matter, any member of NATO, is not going to turn around and say Ukraine can't join, but will they join? How likely is that, Anne-Marie?
You're never going to see a Western leader, especially the President of the United States, say that Ukraine cannot join NATO. But the fact of the matter is, Jonathan, and you're getting to a heart of the issue here, is that, and President Putin knows this, the NATO does not want Ukraine to join. I mean, these are conversations people will not admit in the open, but if NATO joins, if Ukraine joins NATO, that basically sets NATO up potentially for having to go to war with Russia. And that is something they do not want to touch.
Anne-Marie, thank you, down in Washington, D.C., as we wait for Secretary Blinken. And that's what's difficult about this moment, Tom, filled with so much tension. What they will say privately is very different to what they say publicly. And Sergei Lavrov, the Russian foreign minister, I think is speaking to that at the moment, Tom, when he says the following: we're not sure if we'll publish the U.S. response. We will ask Secretary Blinken to make their response public. Sergei Lavrov saying that NATO is viewing Ukraine as its zone of influence. There is a private conversation here, Tom. There is a public one. And of course, all we're getting is the public side of things.
And we're seeing the imagery as well. John, I'm getting in the first images from the IHG Hotel in Petit-Saint-Quentin. That's the diplomatic part of Geneva. This is right near the United Nations efforts, if you will, in Geneva, so historic off of World War II. And I think the imagery speaks volumes. You had Mr. Lavrov at a desk in bad lighting, wrapped around with the press, just 3 flags behind him, not much going on. And the Blinken press conference is much more choreographed with a single American flag, very fancy, the IHG Hotel. The 2 worlds apart, just up the shores from Lake Geneva, maybe speak to the 2 worlds apart of this debate on Kiev and the future of Ukraine.
And we hope, Lisa, those 2 worlds don't collide.
Yeah, we hope that they don't collide at a time also of tenuous alliance. I mean, yes, the European Union and the United States have been allied, but there is a sense that perhaps the United States doesn't have the diplomatic leadership that it once did. And we saw that from Emmanuel Macron of France earlier this week. And I wonder how much this is an effort to regain the helm of the diplomacy effort.
Secretary Blinken, moments away. When that news conference begins, we'll bring you those opening remarks. Very shortly, we'll catch up with George Saravelos, the global head of FX research at Deutsche Bank. So much to talk about in this market. Futures are down again on the NASDAQ. What a turnaround in yesterday's session. NASDAQ 100 futures down 104. We're negative 0.7%. On the S&P 500, negative 22 and down 0.5%. But this time it's different. Through the first 2 weeks of this year, it's been about higher yields and an equity market getting messy. This time it's about an equity market getting messy and sending yields back lower. Down 2 on the 10-year, on the US 10-year at 178.47. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
2 hours away from the opening bell in New York City. Here's the price action for you. On the Nasdaq, down 125. We're negative 0.8%. On the S&P 500, we're down 0.5%. The takeaway from Bank of America, a rate shock is just starting. It's not ending. The Fed is hiking into an overvalued credit and equity market. They call it very 2007. That does not sound good. If this year already feels like a lifetime and we're only 3 weeks into it, this is why. Switch up the board and get to this. This is the story. Year to date, information technology on the S&P is down by 9.6%. On the Nasdaq 100, down 9 percentage points and 10% off the previous high. They call that a correction. This time around, Tom, though, it is interesting, isn't it? It's all been about the bond market shaping the equity market this morning and yesterday. The equity market seemingly shaping the bond market. Switch up the board and get to 10s. Yields lower yesterday. Lower again today. Tom Keene, what do you make of this? We're down 2 basis points on 10s to 177.94.
Oh, I think it's a tension, and clearly in Europe you see it within Lavrov, Blinken. We're waiting for the Secretary of State right now. And, John, you see it with Euro Swissy, a 103.446 shows strong Swiss franc.
Lisa, this is why some people call this a self-limiting sell-off sometimes in the bond market.
Perhaps, although I will just point out that it is driven right now by declining inflation expectations as well as rising real yields. So it could still be potentially damaging for risk assets, even as the nominal yield goes down.
That's the price section. We are waiting to hear from Secretary Blinken over in Geneva. When that news conference starts, we'll bring you those comments. Let's get you some single names now. We can do that with Romain. Morning, Romain.
Hey, good morning, John. Yeah, we talk about official correction territory for the NASDAQ 100 and the NASDAQ Composite. Sentiment certainly not going to improve today, with Netflix down almost 20% here in the pre-market. Should this carry over into the cash session, into the close? This is going to be one of the worst days for Netflix since at least 2012, maybe even worse than that. You don't see these types of moves for a stock of this size here. Only 6 times since they went public have we seen a 20% decline in the shares. A lot of that, of course, has to do with that slowdown in subscriber numbers, a much more aggressive slowdown than what the street had priced in. And I think a real issue here is something that has to be talked about, and the fact that the company really gave no explanation for it. There were a couple questions about it on the conference call, a much more stage-managed conference call than we get from other companies, and they really couldn't come up with a coherent explanation as to why things slowed as quickly as they did. Keep an eye on Disney and Viacom. Both of those shares also lower here in the pre-market, 3% for Disney, 2% on Viacom. Roku also down about 4%. A lot of questions right now about these streaming services and the potential for a slowdown in growth. Flip up the board. The other big stock everyone's going to be talking about is Peloton. Those shares had a brutal day yesterday. They were down 24% yesterday, Tom. They're higher here in the pre-market by 6%. We should point out, Peloton came out with a statement late last night around 6 p.m. or so, basically saying that the initial reports that they were shutting down production, that was false. But they did say that they are cutting costs related to production and that they were considering layoffs. They also came out with preliminary numbers here, so maybe that's why you're seeing a modest bid. But remember, you're talking about a 24% decline that we saw yesterday, Tom.
John, top of market for Peloton is when I bought it. I went a mile.
I don't believe you've ever got on that bite, Tom.
Romain has these cut and chiseled. Romain Bostic, thank you so much. An interesting close, and of course, some important earnings into next week as well. As far as I'm concerned, this is the domestic and the finance interview of the day. George Saravelos has been brilliant, feeding in all of David Folkert's Landau's research at Deutsche Bank into foreign exchange research. And this morning, an absolutely brilliant tour de force paragraph from Saravelos. Let's go to it right now. And you know this, folks, the real wage, it ain't happening. Real wages at negative 2% are the weakest since 2008. This is very different from the inflationary environment of the 1970s when real wages were growing sharply. This is leading to a very different message. The consumer is deferring as opposed to accelerating consumption like in the 1970s. We're going to try Mr. Saravelos now as we wait for the Secretary of State. George, you're more important than Antony Blinken, but let's try this as we can. You take a starkly different view on what inflation will do to our economies. Where will we be in April or May?
Thank you, Tom. I think if you look back through various commentary, we constantly try to find parallels. Is this 2008? Is this 2018? And I think the reality is this is 2022. And it's just very, very different to anything we've seen before. And part of that is the inflation picture you allude to. And what you're seeing in the US now is pretty remarkable. US real disposable income is below its pre-COVID trend. So everyone is very focused on these excess savings, but in terms of future expectations for income, they're going down. You have a story of supply that is frankly terrible. The labor market is shrinking for the first time since World War II, and you exclude durable goods, you haven't had capex. So I take issue with this idea that it's all about strong demand, booming demand, that's why the Fed's hiking. The Fed sure will have to hike, but there's also bad things happening in the background. And I guess the last point to make is, if you look at the starting point of inflation, we're talking about a totally different environment to the last 30 years. The last few hiking cycles have always started with inflation at or below target. So this idea that somehow the Fed can maintain easy financial conditions, keep things nice and smooth, that was the policy objective in the last hiking cycles because inflation wasn't as high. And again, this is a very different environment and a very, very unique one, so to speak.
Well, George, to that point, there is an idea embedded in your words where the Fed has to tighten policy in order to keep the economy from slowing down more because of this restrictive inflation that you talk about from the negative real wages. Can you talk about how they might try to orchestrate a soft landing or whether you think it's too late?
Well, this is really the big question. Can the soft landing be orchestrated? And I think that's precisely the worry of 2022. It's going to be the stage of the cycle we're in. Will we be able to stay mid-cycle or are we going into a more late cycle environment? I think that the jury is still out, but what we can say for sure, it's just going to be much more challenging than last year, where if you look at real yields, you know, they made record lows back in October, November. So this is a very fresh story. I guess the last point to make is if you look at the fixed income market, yes, we have to reprice more for the Fed in the near term to bring inflation down. But more medium term, the rate market has for 6-9 months been giving you this message that neutral rates, trend growth has issues. I think if this continues, what you will see is an aggressively flattening curve. Potentially the curve can invert because essentially the Fed has to hike rates. But the purpose of hiking those rates is to bring long forwards down. It's to bring inflation expectations down. And at the end of the day, that's actually positive for the long end of the fixed income market.
So, George, give us a sense of what you would say to people who point to the labor market and say it's incredibly tight. And sure, maybe real wages are negative, but they're going to go up because you're going to see a rolling over in the inflation, and you're going to see wages continue to accelerate, as we've seen in some of the earnings reports that have come out so far. What would you respond to that?
So I very much agree with the phrase that the labor market is tight. I very much disagree with the phrase that the labor market is strong. The labor market would have been strong if US employment had recovered back to where it was a pre-COVID trend. The Australian labor market is strong. The Canadian labor market is strong. The US market is weak, and that's exactly what is creating this wage pressure. You don't have enough workers coming back in. It's shrinking at the fastest pace in many, many decades. And I think that's precisely what's going to create the issue for the Fed. Wages may be going up, but it's essentially for bad reasons. And it ultimately means the speed limit of the economy is slower than what's assumed.
If you're joining us on Bloomberg Radio and Bloomberg Television, George Saravelis with us with Deutsche Bank, an important conversation on the state of our economics, finance, and investment. John Farrow, Lisa Bramwitz, and I await the press conference of the Secretary of State in Geneva after we heard from Mr. Lavrov earlier. George Saravelis, I want to go all Peter Hooper on you right now. My criticism is a static analysis that's out there right now. You and your team are wonderfully dynamic. Which part of the dynamic continuum of the ISLM structure matters right now?
I think for the market at the moment, it's really all about the speed of this expected inflation slowdown. If you look at current inflation, core PCE around 4%, it's expected to go down onto a two handle. So any deceleration that's not as fast as that will create pressure on the Fed. The key question really is how that interacts into a slowing economy. And again, that has the potential to impact all asset classes, equity markets, of course, the dollar. But the big question for this year for me is really, are we mid-cycle or are we late cycle? And I worry we are in a late cycle situation.
The end is near. Sounds like Bramo.
He does. You know.
I'm loving this. I honestly,
I'm sure
George,
you are.
honestly, it's fascinating. And I have to say that it makes a lot of sense and it goes against a narrative that we've heard continually. So thank you. I appreciate it.
George Saravelis at Deutsche Bank, making Lisa Abramowitz happy this morning. Hey, George, thank you. Just wonderful. That quote that we started this conversation with, Lisa, I think is so important. Unlike the 70s, these consumers aren't chasing these prices. There is a risk they run away from them. That's the point that Deutsche Bank are making.
And George Saravelis was saying that the retail sales, the soft retail sales number that everybody shrugged off as a blip, and maybe Omicron, maybe demand was pulled forward, is actually a demonstration of exactly this, right? Of exactly the fact that people are not spending as much because prices are so high and their wages on a real basis are actually falling.
This is the big risk then, Lisa, and you've talked about it a lot. It's the risk the Fed starts hiking and they hike into weakness. That's the ultimate problem for so many people and for others too, Lisa, it's too late. That we're so late and so far along in all of this now, it doesn't matter what they do. Late cycle, game over.
And frankly, if they hike rates, it's not a policy error because they have to curtail the inflation that's actually leading to a real pernicious cycle for particularly the lowest income earners. The idea that they are having a more difficult time being able to afford groceries and gas and other basic materials.
Tom, we're about to head over to the Intercontinental Hotel in Geneva to hear from Secretary Blinken. Not up there just yet, Tom, but that could be just moments away.
In moments away, I want to squeeze this in, and we'll see if we get this in. This is the essay that set Blinken's world on fire 8 years ago. Mearsheimer of Chicago. I want to get through this quickly as we wait for the Secretary of State. And this is the tension. This is the backstory no one is talking about. I'm trying to get that essay up on Bloomberg Television right now. John, let's pass on the Mearsheimer right now and stay with this image.
Some joint talks a little bit earlier this morning, Tom. We've heard from the Russian Foreign Minister, Sergei Lavrov, and got his view of events. He's saying that Russia is not preparing to go into Ukraine. I think it's very important on a morning like this one to hear from the man himself, the Secretary of State, Antony Blinken. Tom, that could be minutes away, but given what Sergei Lavrov said so far, Tom, what would you like to hear, just briefly?
I think what we'd like to hear is a reaffirmation of what we've heard from the President of the United States at the press conference. John, please, the Secretary.
The Secretary of State, Antony Blinken. Let's take a listen.
Foreign Minister Lavrov and I finished our meeting a short while ago, and I first want to begin by thanking Switzerland for hosting us, for its traditional hospitality, which is very much appreciated. I came to Geneva following up on last week's discussions at the U.S.-Russia Strategic Stability Dialogue, the NATO-Russia Council, and the OSCE on the crisis in Ukraine and broader European security issues. Our objective was to determine whether Russia is prepared to take the diplomatic path and other necessary steps to de-escalate the situation in Ukraine and ultimately to resolve our differences through diplomacy and through dialogue. The discussion today with Minister Lavrov was frank and substantive. I conveyed the position of the United States and our European allies and partners that we stand firmly with Ukraine in support of its sovereignty and territorial integrity. We've been clear. If any Russian military forces move across Ukraine's border, that's a renewed invasion. It will be met with swift, severe, and a united response from the United States and our partners and allies. We also know from experience that Russia has an extensive playbook of aggression short of military action, including cyber attacks, paramilitary tactics, and other means of advancing their interests aggressively without overtly using military action. Those types of Russian aggression will also be met with a decisive, calibrated, and again, united response. That's the clear message coming out of my meetings on Wednesday in Ukraine with President Zelensky, Foreign Minister Kuleba, yesterday in Germany with my counterparts from Germany, the UK, France, and the European Union, and with German Chancellor Scholz. We're united in our commitment to finding a way forward through diplomacy and dialogue, but equally in our resolve to impose massive consequences should Russia choose the path of confrontation and conflict. I expressed again to Minister Lavrov that on the security concerns that Russia has raised in recent weeks, the United States and our European allies and partners are prepared to pursue possible means of addressing them in a spirit of reciprocity, which means, simply put, that Russia must also address our concerns. There are several steps that we can take, all of us, Russia included, to increase transparency, to reduce risks, to advance arms control, to build trust. I conveyed directly to Minister Lavrov our specific concerns for Russia's actions that challenge or undermine peace and security, not only in Ukraine, but throughout Europe, and indeed in the world. I also laid out several ideas to reduce tensions and increase security, which we've developed in consultation with our partners and allies, and where we believe we can find common ground, again, based on the principle of reciprocity. This was not negotiation, but a candid exchange of concerns and ideas. I made clear to Minister Lavrov that there are certain issues and fundamental principles that the United States and our partners and allies are committed to defend. That includes those that would impede the sovereign right of the Ukrainian people to write their own future. There is no trade space there. None. Foreign Minister Lavrov and I also talked about the way forward. Let me say as well that he heard from us and from me that what is for us an inviolable rule, nothing about Ukraine without Ukraine, nothing about NATO without NATO, nothing about Europe without Europe. Based on our discussion, I believe we can carry forward this work of developing understanding agreements together that ensure our mutual security. But that's contingent on Russia stopping its aggression toward Ukraine. So that's the choice that Russia faces now. It can choose the path of diplomacy that can lead to peace and security, or the path that will lead only to conflict, severe consequences, and international condemnation. The United States and our allies and partners in Europe stand ready to meet Russia on either path, and we will continue to stand with Ukraine. I believe that Foreign Minister Lavrov now has a better understanding of our position, and vice versa. Today's discussion was useful in that sense, and that's precisely why we met. So I'll return to Washington this afternoon to consult with President Biden and our entire national security team, as well as members of Congress, and critically, allies and partners in the days ahead. Based on the discussions today, Foreign Minister Lavrov and I agreed that it's important for the diplomatic process to continue. I told him that following the consultations that we'll have in the coming days with allies and partners, we anticipate that we will be able to share with Russia our concerns and ideas in more detail and in writing next week. And we agreed to further discussions after that. We agreed as well that further diplomatic discussions would be the preferable way forward. But again, it is really up to Russia to decide which path it will pursue. I should mention as well that the Foreign Minister and I had an opportunity to discuss Iran, an example of how the United States and Russia can work together on security issues of shared concern. The talks with Iran about a mutual return to compliance with the JCPOA have reached a decisive moment. If a deal is not reached in the next few weeks, Iran's ongoing nuclear advances will make it impossible to return to the JCPOA. But right now, there's still a window, a brief one, to bring those talks to a successful conclusion and address the remaining concerns of all sides. We didn't expect any major breakthroughs to happen today, but I believe we are now on a clearer path in terms of understanding each other's concerns, each other's positions. Let's see what the next days bring. And with that, I'm happy to take your questions.
Andrew Mitchell.
Thank you, Mr. Secretary. Mr. Lavrov has spoken today about hysterical rhetoric, what he calls hysterical rhetoric from the West about an invasion he claims to provoke Ukraine. And President Biden said that with what has happened so far, that he believes that Putin will move in because he's got to do something. So, do you think, as of today, that you have a better understanding from Mr. Lavrov, first of all, of what Putin's intentions are? Do you have any commitment at all that they will stop the aggression that you say is standing in the way of any positive agreement? He says that you are going to present written responses, which you've just confirmed, but he wants them to be to his original proposals, which you and everyone in the administration has said from the beginning are non-starters, proposals to limit NATO expansion. So will your written answers have any different response to him about NATO expansion, which you just said is nothing, is not negotiable? So where do you see a space for any kind of engagement to defuse this crisis? And since you brought up Iran, do you think there is the possibility, after talking to Mr. Lavrov, that you and Russia, the U.S. and Russia, and the other allies, can get Iran agreed to come into compliance, and will the U.S. then agree to lift sanctions, perhaps simultaneously?
Thanks very much, Andrea. First, we're not proceeding on the basis of emotion. We're proceeding on the basis of fact and history. The facts are that Russia has amassed very significant forces on Ukraine's border and continues to do so. 100,000 troops, most recently including forces deployed to Belarus. That would give Russia the capacity, if President Putin so chooses, to attack Ukraine from the south, from the east, from the north. And we've seen plans to undertake a variety of destabilizing actions, some of them short of the overt use of force, to destabilize Ukraine, to topple the government, a variety of things. So, as I said, this is not on the basis of emotion, it's on the basis of fact and also history. Russia invaded Ukraine in 2014, seizing Crimea, provoking an ongoing conflict in eastern Ukraine, the Donbass, changing Ukraine's borders by force. That's what we're looking at. We've heard Russian officials say that they have no intention of invading Ukraine. In fact, Minister Lavrov repeated that to me today. But again, we're looking at what is visible to all, and it is deeds and actions, not words, that make the difference. I suggested to Minister Lavrov, as we have repeatedly, that if Russia wants to begin to convince the world that it has no aggressive intent toward Ukraine, a very good place to start would be by de-escalating, by bringing back, removing its forces from Ukraine's borders, as well as engaging in diplomacy and dialogue, which is what we did today and what we plan to continue doing in the days and weeks ahead. We've said all along that we intended not only to respond to the concerns that Russia has raised, but to share our own concerns, which are many. about the actions that Russia takes that we see as a threat to security in Europe and indeed beyond. And so it was important in the course of the conversations that we've had to date, Andrea, both last week at the Strategic Stability Dialogue between the United States and Russia, at the NATO-Russia Council, at the OSCE, to make sure that we fully understood each other's positions, each other's concerns. After that, and after consulting very intensely with allies and partners, President Biden wanted me to have this opportunity, having digested what we've heard over the last week, and presumably the Russians having had an opportunity to discuss what they'd heard initially from us with President Putin, to really see where we are directly with Foreign Minister Lavrov, to determine whether there is a path forward for dialogue and for diplomacy, and then to look at how we would pursue that. And again, what was agreed today, which was that we will share with Russia a response to the concerns it's raised, our own concerns, and put some ideas on the table for consideration. And then we plan to meet again after Russia's had an opportunity to look at that paper, and we'll see where we go from there. But let me also be clear about this. To the extent that Russia's engaged for now in diplomacy, but at the same time continues to take escalatory actions, continues to build its forces on Ukraine's borders, continues to plan for aggressive action against Ukraine, we and all of our allies and partners are equally committed to make sure we are doing everything possible to make clear to Russia that there will be, as I said, a swift, severe, and united response to any form of aggression by Russia directed toward Ukraine.
You've been listening to the U.S. Secretary of State Antony Blinken there in a news conference at the Intercontinental Hotel in Geneva, following talks with his Russian counterpart Sergei Lavrov amid tensions over Ukraine. Tom, not a negotiation, a candid exchange of concerns and ideas.
This is a Secretary of State, John, within the span of our history, with the one exception of Dr. Kissinger, who totally understands the fabric of this territory. He has family members who were ambassadors to Hungary and Belgium, hugely steeped in the history of the region. He speaks with a certain authority from Geneva.
In his own words, they can choose the path of diplomacy or a path that leads to conflict and consequences. We stand to reach Russia on either path. Coming up, Nadia Lovell of UBS on this equity market, with NASDAQ futures down about 1% from New York City this morning. Good morning to you all. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We do have a broadening bear market.
It's going to be a market where people have to have a slightly longer term view and ride through.
The markets aren't asleep on this. The Fed has been very clear that one way or another, they're going to bring inflation down.
Quantitative tightening most hurts risk markets.
The U.S. economy this year will be relatively solid, but the valuations need to come down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a domestic, a diplomatic, and yes, an economics and finance Friday. The Secretary of State of the United States reaffirms a policy back to World War II. There will be an open-door policy for NATO. That is the heart of the matter, John Farrow, as the Secretary of State speaks in Geneva.
Just one of the big issues for the Russians as they look to Ukraine, Tom. The essence of NATO, as you know, a collective alliance of mutual defense with an open door. The Russians would like that door to be closed for Ukraine. Tom, as you know, the members of NATO can't guarantee that. The separate issue around all of that as well is the strategic weaponry stationed in Ukraine. The president said in the news conference 2 days ago, Tom, that maybe they can do something on that issue. Today, though, was not about negotiations. I think Secretary Blinken was clear about that moments ago, Tom. He called it a candid exchange of concerns and ideas.
Very interesting, and we'll have Tina Fordham on with us here in a bit here to go into the history of this and the path forward. I've got a wonderful look back to 2014 at that moment. But right now, John, we do have to look at these markets, and they are shocked by Netflix.
I'm looking at a single name, Tom, down 20%. That single name had a market cap north of $200 billion at the close yesterday. Have you ever seen anything like this?
No, I have not.
$200 billion names moving
no.
20% on a single day.
This is at the heart of the matter on Wall Street, folks, is the rules that Silicon Valley plays by are different than the signaling that you hear from traditional manufacturers. John, as you mentioned earlier, this was flat out not signaled to the sell side.
I imagine the sell side, the analyst community are both frustrated and slightly embarrassed by this, Tom. To project out looking for 6 million subs and this company says, no, it might have a 2 handle. Clearly, there's a communication error. that divides 2 million from 6.
And part of the communication error here as well is a tumultuous 21 days we've been through in the beginning of this year. Lisa Abramowitz, I think to fold it in, and you've been leading on this, you know what, at the end of the day, it's just about inflation.
Well, I mean, yes, not necessarily for Netflix because they're trying to raise prices. That's a separate story. But inflation, very much concerning to a market that doesn't understand how it's having ramifications on the economy. I keep going back to George Saravelos talking about this pernicious cycle of inflation. The people don't want to buy as much stuff. The people in the lower income tiers are actually suffering real wage losses. And how does this dovetail into momentum at a time when the Fed is going to be forced to hike?
An eventful hour. We hope you stay with us on radio and television through the morning as well. John, let us waltz through the data check to get to our good guest before we get to Tina Fordham. And again, we're monitoring the headlines of the Secretary of State. John, I'm going to go continental Europe. My litmus paper is always euro against Swiss franc as Secretary Blinken speaks from Switzerland, and it's showing me strong Swiss franc.
I'm going to go cross-asset, Tom, and look at equities compared to the bond market. The meal looks the same this morning. It tastes different. The equity market's lower. We're down about 1%. But this time, the bond market is not shaking up the equity market. The equity market seems to be shaking up the bond market. Yields are lower again. 3 basis points today on 10, 6 basis points lower yesterday, 177. That's why people speak of this self-limiting sell-off in the Treasury market, Tom, because at some point it starts to bite into the equity market, then the equity market move starts to flow back to the bond market. Are we just taking a pause from what we've seen in the first 3 weeks of this year?
No pause on earnings. We dive into earnings season next week with a lot of technology names. Nadia Lovell joins us right now, senior U.S. equity strategist at an optimistic UBS. Nadia, frame what you have changed in the first 21 days of January. How have you amended and adjusted the UBS view?
You know, we haven't changed our view much. Clearly, the market has had a choppy start to the year, but it does feel like most of the selling might be behind us. We're approaching some key technical support level on the S&P 500, and that would suggest that the market is near oversold territory. So we are looking forward for this narrative to change and some stability in the market going forward. I think that investors have become somewhat spoiled in the last couple of years of not seeing any sort of pullback to this magnitude. Usually you see a couple of these 5% pullback. So we're starting to see that market approach that oversold territory and really opportunity to start thinking about buying those dips.
And Nadia, you've heard these phrases in the past, don't catch a falling knife. I remember covering the European debt crisis a decade ago. I was told, don't put your hand in a food blender. When it feels uncomfortable, that's when you should buy. How uncomfortable is it now? You said buy the dip on the S&P. Would you buy the dip on this NASDAQ 100?
We have been somewhat neutral on tech for some time. We do think that tech will continue to face some pressure from rising interest rates, and those valuation needs to come in a little bit more. There are areas of tech, though, that we do like, and we'll use the opportunity that's happening at this sort of indiscriminate selling to build opportunity, a position over the long term, particularly in areas like artificial intelligence, big data, cybersecurity. So there's some opportunity here to build position in high quality names with sustainable business models.
Do you think that the market's gotten ahead of itself with Fed expectations?
Oh, we do think so. In terms of our base case is that we expect 3 rate hikes this year, starting in March, followed by June and September. We're looking for balance sheet runoff to start later this year. I mean, what's driving our view is that we continue to believe that inflation will meaningfully moderate as the year progresses. We're looking for under 2% by the end of the year, and we think that will alleviate some of the pressure on the Fed to be more aggressive in its need to bring back monetary policy to neutral.
The reason why I ask is because you expect, or you call for, your firm calls for 3 rate hikes this year versus the 4 that are baked into market expectations. And I wonder at what point you start to see tech becoming a buy. You were just talking about how you're not there yet. It's neutral. But what is the tipping point for you to say, okay, now is the time to really go overweight and to go all in?
I think what you need to see is, one, we'll be watching the earnings season very closely. And so, if the tech companies can put up good numbers, which traditionally they have been able to do so, I think if you got another, 5% or so pullback here in tech, it becomes a little bit more attractive. But right now, we are really focusing on taking advantage of value. We think that value continues to be well positioned, particularly as rates move higher. Financials, we also are looking at energy, given that the continued upward pressure that we have seen on oil prices, and we think that oil prices will stabilize at a higher level. And so we think that energy is also some of the best opportunities right now in the market.
Nadia, I am, and this is my own bias, folks, full disclosure, I'm absolutely fascinated at the comparison of Microsoft using spare change to go after Activision versus the travails of Netflix. I don't want you to do individual stock here, but what's the value of profit right now? What is the value of free cash flow right now?
You know, having good profit growth and also having a strong balance sheet and free cash flow can be a very powerful currency in this market. As you're seeing valuation pull in and some of these tech companies, it is providing opportunities for pickup and M&A, which is already playing out early in the year. And so we do think that that is very valuable. A lot of these tech companies, large tech companies, are flush with cash, and we wouldn't be surprised to see even more M&A activity later this year.
And Nadia, how does the international story stack up now versus the US? I've heard so many people throw around names like Japan, maybe take a look at China as they start to ease. How do they stack up against the US at the moment?
Yeah, we do have a preference to the U.S. I mean, in terms of looking overseas, like Eurozone looks interesting. China, we're still neutral on China, but the market has re-rated downward quite a bit over the last year, and there might be some opportunities there in coming weeks around China. But right now, we are neutral on China.
Nadia Lovell of UBS. Nadia, thank you. This equity market taking another dip, down 0.6% on the S&P, on the Nasdaq 100 down, let's call it 140, down 0.9%. We often say, Lisa, buy the dip, and it sounds so easy until you see one, a 10% correction. This is why people always make things sound very simple and easy in financial markets. And then when you're met by a 10% correction on the Nasdaq 100, if you're in cash, nudge, nudge, hint, hint, wink, wink, yeah. Tom Keene, do you want to go and buy it now? It feels uncomfortable.
It feels uncomfortable because it's edified by some fundamental weaknesses. I mean, if you take a look at what we saw from Netflix, there's some real questions about how quickly it can get back to pre-pandemic levels of subscriber additions, how quickly it can actually pass along inflation costs to consumers when they're trying to expand in areas that are much more hit by the pandemic. I'm just looking at this, and the fundamental story will confirm the sell-off that, as you said, becomes only the more painful to buy.
Futures down 0.9 on the Nasdaq 100. That's the market story over in Geneva. Secretary Blinken, Tom Keene, still speaking at the moment, and this headline jumped out for you, for me, for everyone, because this is the essence of the problem right now. The United States will not go back on a NATO open door policy. I say the essence of the problem, not for the US, not for Europe, not for NATO members. It's a problem for Russia, Tom.
Let us go back to the foundation essay on this. This was hugely controversial 8 years ago. John Mearsheimer, University of Chicago, it was blistering, the criticism from a liberal elite to what Mearsheimer, the realpolitik expert, said. And it was just real simple, as the gentleman in Chicago wrote in Foreign Affairs magazine. I guess we're unable to get that quote up for a second time. What he said, John, is simple. The West screwed this up. They overextended towards Russia. Here it is right now. Let's do it, John. The West triple package of policies, NATO enlargement, EU expansion, and democracy promotion added fuel to a fire waiting to ignite. Later on in the essay, John, a huge expanse of flat land that Napoleonic France, Imperial Germany, and Nazi Germany all crossed to strike at Russia itself. That's the fear of Putin.
Russia wants to close that open door. The US wants to keep it open. Just one of the big issues that Secretary Blinken and Foreign Minister Sergei Lavrov have discussed this morning in Geneva. From New York, we'll catch up with Tina Fordham, the head of global political strategy at Avonhurst, very shortly on this important story. Futures down 0.6 on the S&P, on the Nasdaq down 0.9%. Yields come in too. A haven bid for Treasuries down 3 basis points at 177.23. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. As Tom was just discussing, in Geneva, Russian Foreign Minister Sergei Lavrov says the U.S. Secretary of State Antony Blinken promised to respond next week to Moscow's demands for security guarantees. He also repeated that Russia has no plans to attack Ukraine. Blinken says he told Lavrov that the U.S. stands firmly behind the Ukrainians. He also said that the Kremlin needs to address U.S. security concerns. Now investors are bracing for the prospect that Netflix is entering a new phase of slower growth. Shares of the streaming giant fell as much as 20% after its forecast for new customers disappointed. Netflix also said the slowdown will continue for at least another quarter. China is vowing to curb the influence of technology companies. Authorities say they will also root out corruption tied to what they call the disorderly expansion of capital. This is a sign that Beijing may expand a regulatory crackdown that erased more than $1 trillion of market value last year. Banks here in England are starting to bring staff back to the office now that the government has changed its guidance on the matter. Barclays is reverting to hybrid working arrangements. HSBC has told their workers they can return and they will no longer be required to wear face masks. Meanwhile, Deutsche Bank will also start bringing workers back to its London offices. And the rock superstar known as Meatloaf has died. His late 70s album Bat Out of Hell had hit songs such as Paradise by the Dashboard Light and 2 Out of 3 Ain't Bad. It became one of the best-selling albums in history with more than 40 million copies sold. Meatloaf was 74 years old. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Discussion today with Minister Lavrov was frank and substantive. I conveyed the position of the United States and our European allies and partners that we stand firmly with Ukraine in support of its sovereignty and territorial integrity.
Secretary Blinken from Geneva, from New York. This is Bloomberg alongside Tom Keene and Lisa Bramberts. I'm Jonathan Ferro. Your market is set up as follows. Futures are down. They're down hard on the Nasdaq again by about 1 full percentage point. On the Nasdaq 100 down 146. On the S&P down about 28, down 0.6%. Yields are lower this morning though. We're down 3 basis points to 177. On the week, the Nasdaq is down really hard, off by almost 5%. Going into the opening balance, it's going to be more than that coming out of it. 2-year yields are only up by about 4%. 4 basis points to be precise on the week. Tom, it's a different flavor to the end of the week now. It's a treasury market bid. This is pure risk aversion. This is what it typically feels like. It's not the first 2 weeks of the year where yields were blasting higher. It was shaking things up in the equity market. It's flipped. I said a little bit earlier on, start of the year, the dog was wagging the tail. Right now, the tail is wagging the dog.
And there's just a tone, and yes, it's a diplomacy we're seeing in Geneva. Mr. Blinken is done with his comments. But, John, it's also, as Lisa mentioned, getting into next week. How many Netflixes are there to come next week?
For big tech, and you've got the multiple issue as well, Tom. You've got the valuation story. We still haven't worked out what that balance sheet reduction is going to mean for this market, Tom.
Right.
And the numbers that are out there at the moment, Deutsche Bank, Matt Lazzetti and Peter Hooper throwing out big numbers for next year. $1 trillion of balance sheet reduction next year at the Fed. This year, about $500 billion. Throw in 3-4 rate hikes. That's a lot to take in before it even happens.
NASDAQ down 1%. We just got a 27 handle on the VIX, which speaks volumes on a tumultuous Friday. Our goal is to bring you experts, people with zero BS about the things at the moment, and we've hit a home run out of the park here over the Massachusetts Turnpike with Tina Fordham, head of global political strategy at Avonhurst, with her academics at Columbia and far more her ability to traipse across the Atlantic like no one I know. Tina, thrilled to have you on at this historic moment. Secretary Blinken's family is steeped in Eastern Europe, steeped in this fractious relationship between Russia and the West. I featured the John Mearsheimer Realpolitik moments ago, the idea that NATO is overreached. How does the President of the United States react to Mr. Putin's belief that we have overreached?
President needs to hold the line, and Secretary Blinken, as you said, with his family history in Eastern Europe, just like Angela Merkel, the former German chancellor, knows that you cannot show weakness to Vladimir Putin. Blurring the red lines, dividing the West and NATO is part of what's happening here.
How do we show strength away from sanctions? What are the avenues we have east of Kiev?
Well, whilst we've all been busy with COVID, fighting COVID and everything else, Russia has been able to make significant inroads in destabilizing its former satellite states, Lithuania, For example, Belarus with the protests and the support that's come from Moscow, also support from Moscow to some current EU member states. That is why, to those who ask, why now, I would say we've got U.S. midterms in November, as all Americans know. We've got a new government in Germany. We have the UK focused on its own troubles. If there was ever a time to test the resolve of Europe and the United States when it comes to enforcing borders and other measures, now is that time. I think the question that, to refer back to what you're saying, is whether the sanctions that have been suggested, these massive sanctions, the sanctions from hell, are going to be enough to deter Putin, who might be thinking that we won't be willing to do the big stuff, like sanction Russia against SWIFT, for example.
Tina, there may be other lessons, though, that we can take from some of these meetings, in particular the relationship between the United States and the European Union. Is it significant that Antony Blinken went first to meet with Olaf Scholz, and that he really emphasized everything that he said? We will work with our allies. We have decided on a plan. This is ours. Is that notable, and frankly, a notable departure from the previous administration, and enough to create a strong coalition?
Well, you're right that it's making more of an effort coming from Washington than usual. But I can tell you that when those U.S.-Russia bilateral meetings were announced for Geneva, the Europeans were very concerned about decisions being taken about Europe without Europe in the room. Since then, Tony Blinken has been at pains to emphasize the importance. But speaking to you from here in London, there is plenty of reason to be concerned that the failure of this diplomatic initiative is going to lead to a serious gas price crunch in Europe, or a gas supply crunch rather, and a price hike. And of course, Ukraine is also important as an agricultural producer. So we feel the effects here in a way that is perhaps more realpolitik for the United States.
Tina, if you were advising big multinational companies about how to prepare for some sort of escalation here, what would you say? What mindset should they get in as they prepare for either sanctions or even some military altercation?
Well, I do advise big multinational companies and institutional investors. That's exactly what I do as the chief global political strategist. And one of the things that I have emphasized in my methodology is that we cannot treat these types of events as tail risks. Nobody needs a geopolitical analyst who cries wolf all the time. And so as a longstanding Russia watcher, I'm saying now that this conflict is entering very serious territory. You need to stress test against waking up to a headline that says Russia has crossed the border into Ukraine. Now, in addition to that, there are some perhaps less destabilizing but still concerning possibilities. For example, a de facto or a soft annexation of parts of Ukrainian territory. And let's remember, we've got troops, Russian troops now stationed in Belarus, in addition to those amassed on the border with Ukraine.
Tina, Peter the Great, I know you know this, served for 42 years. I should say reigned for 42 years. Mr. Putin is catching up very quickly. Let's look at Putin the Great in the heart of the matter, which is the Russian people have always projected south to the waters. They need a navy. It's been that way forever and ever. Explain to us Mr. Putin's feelings of Ukraine as an avenue to Crimea, as an avenue to the Black Sea, and how the U.S. Navy and NATO should respond.
Well, I love what you're saying. I lived in St. Petersburg for a time a million years ago in my student days. It was frozen, so for half the year, and so didn't have direct access to the water. The Russian Empire, of course, came before the Soviet Union. Having those channels has always been important. Putin does see himself very much in one of Russia's great leaders alongside the czars. He's written extensively about this. But if we take what's happened in Kazakhstan, for example, in context, Putin's dream of having kind of safe pro-Russian buffer states all along the border is starting to crack. The Mearsheimer quote that you put up, interested me very much. Of course, one of the most important professors of international affairs and leaders on this. What Mearsheimer says that perhaps NATO has overreached is echoed by a lot of the investors I talk to. Why are we doing this? Why are we, poking the bear? Here's where we bring in U.S. diplomatic history that says the United States can't allow any regional hegemons. And that's where what happens in Ukraine is watched very closely in China and by Taiwan, right? Because both China have a big thing in common, and that is wanting to be the regional hegemons without risking U.S. or Western military blowback. And of course, that worries all of the smaller countries around them. So will the U.S. be able to maintain its global position? That's what's at stake right now in Ukraine, and that's what Secretary Blinken is going to be trying to project.
Tina, thank you. I think that final point is so important. Tina Fordham there of Avonhurst. Tom, it's more than just Ukraine, Russia. It's China, Taiwan as well. And those two issues are different, but they have a lot of things in common too.
That was a real clinic, and I think, John, I'm going to be honest, this discussion, John, folds right into your framework of economics, finance, and investment. This is not discrete and separate from the real world of Bloomberg surveillance.
The geopolitics, and ultimately a question you've come back to repeatedly, Lisa, the issue of the moment, which is inflation and what happens with energy markets. And for Europe, this situation with Russia is vital.
It's vital because they rely on Russia for so much of their natural gas at a time when natural gas prices are really leading the inflationary push that led to some 5% in the Euro region. Interesting to see how the United States tries to shore up trust with the Euro region as they kind of go it alone in these meetings. I thought it was fascinating what Tina Fordham said, the fact that they still went to the meetings to represent Europe without Europe in the room, and now trying to reach out with an olive branch.
We've got to push forward now to a couple of central bank decisions. The Federal Reserve is next week. The week after that is the ECB. We've heard from the ECB President, Christine Lagarde, this morning, Tom. She said in the last hour, the ECB not seeing wage deals being, quote, way up, not seeing inflation spiraling out of control. The ECB must be data and state dependent. No question the ECB will act when conditions are satisfied. The problem is for the ECB president, Tom, there are some people on that governing council that no doubt once we get to the end of the year will believe those conditions are satisfied.
Oh, there's such a cultural overlay here, John. And, I agree. The EU calculus is so different from what we're seeing at the Eccles building. But, what it comes down to is do they become overcome by events? And it's amazing just in the last 48 hours with the data that Madame Lagarde mentions, how things have changed.
Yeah, and I think a lot of people, Tom, you and I talked about this going into the end of last year. Many people are waiting for the end of this first quarter because of the base effects around the inflation story. The bar just starts to get higher, particularly stateside, and there's this hope inflation fades. So Can you forecast Fed policy out to March? Probably. Can you forecast Fed policy after that without seeing the inflation numbers through the summer? That's a little bit more difficult.
You sound like a professor. I agree, John. You move along in time, and that's the economic mumbo jumbo. Our audiences don't feel it that way. Our audience on radio and TV, they're like, don't give me this 12-month overlay, it all gets upgraded and that. They're like, wow, prices are up.
I'm pretty sure it's an insult, Lisa. Although I know Tom likes professors. He loves professors.
He loves professors. Dr. Farrow. I mean, we're going to be discussing this for a long time.
My dad always told me if you can do, if you can't teach.
John, we didn't talk enough this week about the tots.
Ramo's dad's very upset with that, so I take that back to Mr. Abramowitz, Professor Abramowitz. I apologize. Futures are down. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
An hour away from the opening bell, this equity market is not looking good again for the equity bulls on the Nasdaq. The Nasdaq 100 futures are down 0.8% on the S&P 500. We are light to lower, softer, -21. We're down 0.5%. Stat of the morning of the last 24 hours from Bespoke, the first time in over 20 years that the Nasdaq was up 1% intraday and finished down more than 1% on back-to-back days. That's been the story, just a huge turnaround. Into the bond market this time, yields are lower again. Yesterday, today, we're down 3 basis points to 177 on 10s, Tom. A week away, next week, the Federal Reserve decision.
Let's get smart right now, John. And what we need to do is get smart with someone with a claim in academics, but also a prize you don't know about, folks. It's the Deter Prize at Harvard University, or Harvard College, I should say. And what it is they find the people younger, earlier, really doing well. Bonnie Wongchukul is one of those people, winner of the Deter Prize at Harvard, and we're thrilled she could join us in the real world of portfolio management at the wonderful Western Asset Management. Bonnie, thank you so much for joining. I love in your essay, you talk about our predetermined paths, and as Madame Lagarde mentioned this morning, our data dependency. Tell us about our determined data dependency. We're just slaves to it, aren't we?
So the Fed is going to be very data dependent from here. I think the market has been really focused on the hawkish communication that came out of them in December and this pivot that they did. But at the end of the day, the Fed is still going to be looking at the data. You know, we have seen volatility in the rates market because the market is calibrating to what they perceive as this new Fed. But ultimately, as I said, the Fed is focused on one thing, which is the evolution of the data. When we look at the data and the past couple months of data, we're not really seeing the case for what's being priced into the rates market. We're seeing a slowing down of the economy. That's what we're expecting this year, is a moderation of growth back to trend. We have seen job growth slow down, and we've seen retail sales disappoint. And so I think we're seeing the case for our view.
You have a little bit of experience of this back to Donaldson, Lufkin, Generat in your years there. You know what a bond bear market is. Are we price down, yield up, a bond bear market?
We're not calling for a bond bear market. As I said, our fundamental view is that the economy is going to slow down. It's not going to be growing at the same pace that we saw before. We're seeing consumers' disposable income on a real basis decline, and I think you're seeing that reflected in numbers like the retail sales. And that wouldn't support a bond bear market. And I also think you're seeing that reflection in the way that the Treasury curve is behaving. You're seeing more of the rise in the intermediate part of the curve, while the long end is remaining fairly contained. And I think that shows that there is a view that longer term growth is really going to be consistent with the trend we saw before COVID.
Bonnie, when you talk about disposable income, I go back to George Saravelos and this idea that real wages are actually deeply negative. Going back to 2008, we really haven't seen this type of dynamic, and their disposable income is coming down. How much does this actually push the Fed to move more quickly, to hike rates, to try to curtail some of the inflation that's stripping away their earnings?
So it's a bit of a balance, Lisa, for sure. So the Fed wants to address inflation. It is all over all the headlines and it's on the top of consumers' minds. But at the same time, they want to encourage participation in the labor force and keep the conditions so that people can re-enter. We still have 2 million workers that are prime age. There's been a lot of talk about early retirement, but we're talking about prime age workers that are not yet back in the labor force. And so we think that the Fed wants them to come back. They want them to earn some wages and to enter the labor force. And so the Fed is going to have to balance between those two sides of its mandate, both the inflation side and the employment side, which I think argues for them giving the data a little bit more time and seeing how we can see whether we can get workers back into labor force and have that labor force participation rate go back up.
So is this formula basically calling to buy duration? Are you basically going out there and buying the sell-off that we saw in tandem perhaps with other people today who are coming in and at least giving bonds a bid?
Yeah, so we're constructive on duration. We think that you really have to have some treasuries in your portfolio for diversification purposes. But we also think that at these current rates that they do provide some value. We think that the Fed is a bit overpriced and that we could see some rally in the market because there's going to be a realization that that is overpriced and that rates could come down.
Bonnie, those are really important comments. You are constructive on duration. You want to have the courage to go out in maturity to buy the price for the price to move up and a presumed yield to go down. Translate that over to the Fed parlor game right now. I know no one at Western Asset pays attention to the Fed parlor game, but are the people screaming for 4 rate cuts? Are they wrong? Rate rises? Are they wrong?
Well, it's possible that we could see 4 rate cuts, rate hikes.
I'm sorry, that's my fault, Bonnie. I messed you up. It's completely my fault. Continue.
That's okay. It really, as I said, depends on the data. It is not our call. We think that for them to get in the full 4 rate hikes that are being priced, you'd probably want to see some acceleration in the inflation. Remember that the Fed's call is that inflation is going to moderate over the year. They're expecting that in the second half of the year. So I think they're going to wait and see what the next few months bring. If inflation continues to be elevated, that's not inconsistent with either our view or the Fed's view. It's just that it has to come down ultimately and go on a downward trend going into the end of the year.
Then what do we do? Let's talk about, with Western Asset, it's a more long-term investment. Your idea of short-term is 3 years or 5 years. I get that. But what do investors do who aren't going to be in Netflix? They're not going to be in the equity market. They need to clip a coupon or find total return. What's the mix of fixed income that looks most appropriate?
So we think that spread product is still really well valued here and that it can do well this year, even if we see some tightening in financial conditions. And so we're selectively overweight across the different spread product classes, corporate credit, structured product, and EM. So, for example, within corporate credit, we really do believe in our rising stars that our analysts have selected. We think that those will continue to benefit as the economy continues to mend. And we also think that there are select reopening trades, within airlines, cruise lines, autos that still look good here. We also really like bank loans. That's a sector that we think the spreads are very attractive. Default rates are coming down, and we're even seeing ratings upgrades there. And I would say the biggest reopening trade that we have right now is emerging market debt. It's really priced extremely attractively. And if we are really approaching this point where the peak divergence between the Fed and other central banks is really coming close, then that is a very good condition for emerging market bond performance.
Bonnie, given the fact that there is so much turmoil that's expected this year and we're coming off very low yields, what do you say when people talk about the volatility and how you hedge against it and the potential returns that they can expect? Big institutions, pensions, endowments, what is an appropriate bogey?
In terms of hedging against volatility, we still think that treasuries are the best diversifier. You see it in price action. This is a relationship that has held over time. And so for us, that's always the ballast of our portfolio. And I think the other thing is just diversification in general. Our philosophy at Western Asset is to have a group of diversified trades within the portfolio where we have high conviction, where we believe in the fundamental value, and where we think the portfolio will do okay, even if our base case doesn't come to fruition.
Bonnie, thank you. As always, Bonnie Wanshikal there of Western Asset Management. Now, this next headline comes with a warning because it's incredibly divisive. Some people will care, others really won't. This coming from some reporting over in a Swiss-German newspaper, Tom. The World Economic Forum to take place in Davos, May 22nd to May 26th. A press release confirming the dates is said to have been prepared. I believe that hasn't been sent out just yet, Tom.
John, we go to the sources as well. John, we need on radio and television to nail this down in May.
Sure.
Das WEF findet im Mai in Davos statt.
Nice.
Did I do okay there?
Can we get the Bramo cam back up?
No, please don't put, no.
Lisa is suffering.
I'm sorry.
I mean, I did say, honestly, Lisa, some people will care, a lot of people really won't, but they're the dates, okay?
Okay. I mean, honestly, anyone have more Meatloaf lyrics? I think that people would rather that. I'm just, honestly,
Lisa,
I think
you
it's
can
great.
bring the kids.
To the WEF. Please do that again.
Please don't. You feel tortured by this show this morning. Let's push ahead to the Fed next week. We've got an S&P 500 down 0.5%, and NASDAQ 100 that's been absolutely brutal this week. It's down almost 5%, and once we open things up at the opening bell in about 50 minutes from now, Lisa, that's where things are going to end up. It's been tough. And this week at the back end, it's not just about the bond market. Yields are lower today. They were lower yesterday.
And honestly, it's very much, again, you've raised this question. How did Netflix guide so poorly? Why did they not give some sense that their subscriber numbers would come in so much lower than expectations? And what does this mean for other big tech companies? I understand that it's an idiosyncratic story, but still, the bar is high and disappointments are severely punished.
John, you've been cold to me so long, I'm crying icicles instead of tears.
I knew it would start. But can you say that in Swiss now?
Yes, can you say that in German, Tom?
German.
We would love that.
Frozen to me so long.
Nice. You're not offending anyone at the moment, Tom.
Instead of irrites.
You're not offending anyone. Thank goodness I'm alongside you to rescue you. Just to be clear, this is a report coming out of Switzerland. They've asked the World Economic Forum.
The Swiss paper, yeah.
Asked the WEF for comment for the press office. They haven't had a response to that just yet, and I'm sure many of you just couldn't care less. The equity market is down hard this week, Tom, and I want to talk about Netflix a little bit more.
I want to. Please keep going.
Netflix down 20% in the pre-market. This is a $200 billion name. Tom, this is not a penny stock. It's not a playground. It's the U.S. equity market.
I wonder,
it's a mega cap.
Seriously, into the weekend, you drive forward. What does it mean for the confidence of sell side into the earnings and look forwards next week?
Well, clearly, the confidence around this name has been absolutely hammered. Now, we've seen moves like this after earnings with Netflix before, but to see a move bigger than 20%, you've got to go back to 2012. It wasn't a $200 billion name back then. And Tom, isn't that your issue with this as well? Isn't it time to grow up a little bit?
Exactly. That's exactly it. And I want to be honest. I hate the bundling of the FANGs. I love Jim Cramer. I'm sorry. They've got $1 billion in free cash flow. Microsoft has $65 billion in free cash flow. They're not comparative as institutions.
John, were you talking about Netflix? Isn't it time to grow up a little bit?
I was talking about Netflix. Futures down 0.5%. David Kelly's going to join us. An adult conversation on Bloomberg TV with a global strategist, global chief strategist at JP Morgan Asset Management. This was a weird one, wasn't it? Very strange.
I don't even know where to begin.
We'll cover the bond market on Bloomberg Real Yield. Maybe that will restore your faith in programming with us a little bit later. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Bitcoin fell today to the lowest level in more than 5 months. The world's largest cryptocurrency dropped below $40,000. It hit a high of almost $69,000 in November. Other cryptos fell too. Virtual coins have become a symbol of the retreat in speculative investments sparked by the prospect of tighter monetary policy. Now, China's quietly urging banks to increase lending after a slow start to the year. Bloomberg's learned that the PBOC has given so-called window guidance to large state-owned lenders and regional banks. It is urging them to extend more credit to companies and households. Bank lending in the first 2 weeks of the year was lower than a year ago. IBM has agreed to sell its IBM Watson Health business to private equity firm Francisco Partners. Terms were not disclosed, but the price is said to be more than $1 billion. IBM Watson Health helps medical providers manage data. IBM's new CEO, Arvind Krishna, has been focusing on foster-growing cloud computing operations. Bloomberg has learned that Intel plans to build what it expects to be the world's biggest silicon manufacturing site. The company will spend $20 billion on the chip-making hub in Ohio. Intel CEO Pat Gensler tells Time magazine the company will use the new facility to research, develop, and manufacture its most advanced chips. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
You mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the tests strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is affected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars,
We are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon. Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips.
The wonderful Jeremy Grantham, what a gentleman, a GMO and a co-founder, one of the experts of measuring value in the equity markets, and he is, to be kind, cautious. We have 14 topics right now. Lisa Bramos and Tom Keene. I'm Bloomberg Radio. I'm Bloomberg Television. To speak of, to one, B. Ritholtz. Barry Ritholtz joins us, columnist and Ritholtz Wealth Management, skeptical reader of the sell side. And we're going to rip up the script right now. We can do that with Barry Ritholtz and talk, Barry, about something that John Farrell brought up this morning because I was too polite to bring it up. But you and I are going to nail this right now. Netflix started in a 36-mile commute of two really, really bright people from Santa Cruz up to Sunnyvale on the way to San Jose and San Francisco. It is truly one of our great companies. Not only that, but they've reinvented themselves, what, Barry? 3 times. But they have the greater Silicon Valley arrogance about not informing the sell side of the state of the company before earnings. Is that what happened yesterday?
You know, you're more kind than I am. Whenever people say earnings misestimates, that's always backwards. Earnings are going to be what earnings are. The estimates got it wrong. And it's not the responsibility of Netflix to do anything other than share the occasional update with the analyst community. It's up to the analyst community to figure out, hey, are they hitting all their targets? Are they going to do what we think they're going to do? This has been richly priced for a long time. It obviously had a wonderful surge benefiting from when everybody was locked down, stuck at home, couldn't go out to theater, athletic events, movies, whatever. And a lot of what's going on is the market betting that the lockdown era is coming to an end. And I don't think the analysts figured that out. Whether it's subscription growth or total hours viewed, they're not getting that.
I'm going to take your point in that Dover, industrial Dover of the boring Midwest, has 18 analysts, and they're a whole different culture away from the big tech analysts, aren't they?
Yeah, this is the challenge with looking at Netflix. They're a content creator, they're a service, they're a subscription model, and they're a film studio. And so when you add all those things together, you know, how are they selling their product? How much are they spending? How much are they borrowing? It's a very, you know, to give the benefit of the doubt to the analyst community, this is a very difficult company to get a handle on. There's a lot of moving parts. That said, I wasn't expecting a 20% decrease, but you look at how far Netflix ran up into the pandemic. It actually hasn't done a whole lot of anything recently. This isn't the greatest surprise in the world.
Okay, so it might not be the greatest surprise to you. However, obviously a lot of analysts got it very wrong, which is leading other people to wonder ahead of next week's tech earnings. What else did they get wrong? What other miscalculations in terms of the dynamism of the clientele of the tech behemoths? What's your sense? Is that a fair crossover, or do you think that this is a unique story?
So, you know, when we look at S&P 500 earnings and we average somewhere around 60-65% of companies actually exceed earnings consensus, more than half. That's telling you, hey, the analyst community are just spitballing, and the companies are manipulating them in order to play the game. Let's beat by a couple of cents, or in the cases of companies like Microsoft and Apple, where they're beating by hundreds of millions of dollars. That's been the game for a long, long time. When we look at the past year or two, the numbers have been substantial. It's been much greater. Off the top of my head, I think we were around 80% of companies in the S&P 500 or more were beating analysts' expectation, significantly above what's been traditional. And that kind of suggests that the entire model of guessing earnings and guessing revenues is deeply flawed. It certainly never helped me make money in the market.
Okay, so help other people make money in the market. Would you be buying the dip at this point that we have seen, particularly in tech stocks? No, I mean, honestly, in the NASDAQ in particular.
So it's very early in whatever sort of correction we're having. My guess is that what we're really going through is the market finally wrapping its head around rising rates and adjusting to that. We knew it was coming eventually, but for a long time it looked like it was 2 years off in the future, and now it's 2 months off in the future. So that's part of this. Keep in mind, we've had an amazing run, not just since the pandemic lows. The past decade has seen spectacular double-digit growth in the S&P 500 based on record fundamentals. Everybody wants to credit the Fed. Look at the earnings growth that you've seen over the past 12 years. It's been spectacular, not counting the pandemic. Right. So, the market has had a great run based on great fundamentals. And it looks like this is going to be a pause to digest some of those gains. This doesn't smell like the end of the bull market to me.
Got to go to breaking news. Barry Ritholtz, thank you for perspective on Netflix as well. Lisa, quite a headline coming out. The United States of America weighs evacuating diplomats' family members from Ukraine. That's immediate.
Under the plan, non-essential staff would be able to leave voluntarily, while family members would be ordered to return home. An announcement may come within days. This comes after conciliatory tones from the Russian Foreign Minister and Secretary of State Antony Blinken. And yet here we are looking at material moves in preparation for a potential Ukrainian invasion. So it speaks to a very different message just moments after that meeting. And
I don't even have time to type. Matt MacArthur, help me out here and get up the 10-year German yield. It's a litmus paper of the European system, GDBR10 index on the Bloomberg, and it shows the emotion of this announcement with a nice drop down from a negative 0.06 pushing down to negative 0.7 right now. So we're seeing a significant move when we've yet to find support to the price of the German benchmark yield. Lisa, quiet day.
Yeah, quiet day ahead of next week's Fed meeting. We've got the geopolitical landscape. We have the central banking landscape. We have the earnings landscape with Netflix and the tech earnings next week. The takeaway is nervousness, and that we really see that nervousness increasing and growing. And perhaps you're getting a bid to bonds, but you're still not getting a bid into stocks. This game has moved far away from just a Fed story.
Now, and again, I'm going to look at it through the litmus paper of the volatility of the Standard & Poor's 500. The VIX, I had a 27 print earlier. 26.90 is not the 21 where we began the week. We continue the tumultuous news of the day. We continue on Bloomberg Radio and Bloomberg Television. Please stay with us across all of Bloomberg. Good morning.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Can you believe we're only 3 weeks into this in 2022? From New York City this morning, good morning, good morning. Your equity market is down and down hard on the NASDAQ, down another 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, looking ahead to the Fed.
The next meeting is very important on Jan 26th.
The Fed meeting, Chair Powell.
Powell couldn't have been clearer.
The Fed is going to have to move.
There are really three things they have to do.
They've got to immediately stop QE.
Deliver the balance sheet reduction.
They've got to hike interest rates.
In March, it's go time.
People are a little aggressive. If anything, they'll move slow to begin with and then risk the policy mistake.
If they're going to make a policy mistake, it's because they move too slowly.
We have 7% inflation. What could possibly be a bigger policy error?
It's frankly too late for the Fed to engineer a soft landing.
They've waited so long.
The key is going to be a very measured approach.
Joining us now to discuss is BlackRock's Gargi Chowdhury, JP Morgan's David Kelly, and Jay Poloski of TPW. Gargi, I want to begin with you. Looking ahead to next week, that Federal Reserve, what are you looking for?
Sure. Hi, good morning, Jonathan. Great to be here. So definitely this is going to be a Fed that talks about the improvements that have happened in the labor market and obviously having reached the target on inflation as well. So we're definitely going to hear that message from the Fed, and then a preparation. I mean, obviously we've heard from enough Fed speakers at this point since the beginning of the year to know that they are preparing us for a March rate hike. So more on that. I still think it's too early to get any definitive answers on the balance sheet. I do think at the press conference, what I will be watching for is some answers around what discussions are taking place on the balance sheet. That is something I think that'll happen later in the year, but I think still too early for the January meeting next week.
Such a massive range of views out there at the moment, David Kelly. SocGen and Subhadra had this to say: the Fed is likely to push back on market pricing of more than 4 hikes for 22 as it prepares to embark on a rapid pace of balance sheet runoffs in a second half. David, if you're in this market at the moment, I don't know how you discount any of this. We're talking about $500 billion of balance sheet reduction at the end of this year, $1 trillion next year. How do you factor that in?
Well, I think you have to recognize that rates are going to go up. I think that, next week, I think the Fed's going to be, first of all, they're going to have to explain why they're not moving now. And I think they will point out that there is significant disruption to the U.S. economy in January because of the Omicron variant. And we still have a lot of uncertainty with regard to fiscal policy. So I think they have a pass for not making a decision next week. But I do think they're going to put in 4 rate hikes over the course of the year ahead. And I think for investors, you've just got to think about what does a 10-year Treasury yield, say 1% higher than we have right now, what would that mean for every asset in financial markets, and position accordingly.
Let's position accordingly, Jay. Right now, the NASDAQ is down about 10% year to date. The NASDAQ this week is down almost 5%. We can pick a name. We'll talk about a single name a little bit later. Take Netflix. It's down by 20%. A $200 billion company, a fifth taken off just like that. Jay Pawlowski, we're used to this story that when you start to see stuff like this, the Fed gets nervous and backs away. They haven't even done anything yet. Is it different this time?
Exactly, John. I mean, it's all on the come. I mean, it's like this week. This is the longest short week, I think, in history, right? It's only been a 4-day week, and it feels like it's been 2 weeks rolled into one. Markets have been discounting action, like you talked about Netflix, for well over a year. This has been a twin-engine market where growth has led and cyclical and value have underperformed. Cyclical and value now finally starting to perform as rates back up. And that segment of the market has got tons of room to run. Likewise, the non-U.S. markets have tons of room to run. And we're starting to see that, John. Commodities are up 10% year to date. Non-U.S. down 1 versus the U.S. down 6. Value down 2 versus growth down 10. So there is some opportunity sets out here, just not the stuff that has been the leader. And so I think in the midst of all the other action with the Fed, we're in a leadership transition, both geographically and sectorally and factor-wise within financial markets.
We can talk about how important the bond market is in that context. For much of this year, what we've seen is the bond market shaping up the equity market. This morning, it feels like the equity market shaping the bond market. We saw that yesterday with yields lower again today, down 4 basis points on 10s to 176 on 2s, a break of 1% again, just south of that level at about 0.99%. I want to head over to Mike McKee and get a view on next week. Mike McKee, get us up to speed. Are we getting a hike next week? I've heard this 50 basis point story on the table now.
Yeah. Not next week, but what the Fed does is going to be the most important decision they've made in 2 years. They're going to be taking the markets and the economy with them, as well as central banks around the world. If you think of the Fed as the old trope of an ocean liner moving very, very slowly, they are getting ready for a course correction next week. They probably won't turn the wheel, but they will lay out a roadmap. And the cartographers on Wall Street see a slow and steady correction beginning with a 25 basis point rise in March. Bloomberg survey of economists shows an expectation of 3 hikes this year to bring Fed funds to 1%, 2 next year, another in 2024, the terminal rate of 2.25%. But if the past is prologue, the economists have also built 2 pauses into the hiking cycle, the first next fall, so the Fed can see where we are and assess what they should do next. Second issue, as you mentioned, the balance sheet. When do they start shrinking it? How far? How fast? Again, the questions that will be asked and hopefully answered next week. Probably not in terms of the balance sheet, but we may get some guidance in the minutes of the meeting. For now, trading desks coalesced around the idea of starting sometime between July and September. 2 outlier calls. Again, you mentioned one is stop tapering immediately. The other 50 basis points, nowhere near consensus, but they are being talked about. Finally, forward guidance. We're no longer waiting for inflation above 2% and full employment. So what do they say about where do they go from here? That's what we're looking for.
That's what we're looking for next week. Looking forward to covering it with you. Mike McKee, this is the story of the last 10 years or so. The more we price in, the less the Fed can do. Financial conditions tighten, they back away. The more the Treasury market sells off, it becomes self-limiting. We've seen some of that this week. Yields higher, starts to hit equity markets lower. Once again, yields lower. Are we just pausing, or is this the end? Bank of America say this is not the end of the rate shock. It's just getting started. They look back to the 20th of January, 2020. Yesterday, 2 years ago, it marked the first confirmed COVID-19 case in the US. 2 years later, just 6% of investors see COVID as the biggest tail risk in the next 12 months in their global fund manager survey. The end of the pandemic equals the end of excess stimulus, and that equals the end of excess asset returns. Gagi, is it that simple?
Is it that simple? Well, no. There's a little bit more that's going on under the hood for sure. So yes, you know, a lot of people are getting optimistic, I would say, about the pandemic becoming more of an endemic. But at the same time, I think we have to be cognizant of the fact that we are now dealing with an economy where the Fed is going to remove accommodation, and that's very much warranted. So if we just look at how much inflation has moved, if we think about where the unemployment rate is, near Nehru or even below that, I think that this is an economy that's ready for rates to get off these emergency levels. And I think that's what we're going to hear from the Fed next week, and that's what we're going to hopefully get in March. I know that there was a little bit of question and a little bit of anticipation earlier in the market around a 50 basis point hike in March. And you know, that just doesn't seem like the type of action that this Fed would take. They've had plenty of time to prepare the market for such an outcome, and they didn't do that. So I think this is going to be a Fed that is going to be very nimble, a Fed that is going to respond to the data. And at the moment, the data is pointing to an economy that no longer needs emergency levels of accommodation.
Well, let's talk about the trajectory for this economy, the runway for the year ahead. David Kelly, what are your expectations? Q1, do we front load some weakness here associated with Omicron and bounce out of it? What are you looking for?
Well, we think we could see up to 7% growth for Q4 and down to about 1% growth for Q1. So I think there's going to be a very sharp slowdown. And the thing that I worry about is, you know, I've been arguing for years that the Fed is being too easy. And I think they should have started removing accommodation last year, much earlier. But the classic Federal Reserve mistake is overreacting late. And I think there is a risk that if they, you know, now tighten, if we have tighter fiscal policy at the same time, and you've got an economy operating at full employment with very low levels of labor force growth, this economy could slow down too much. So I think that risk is also growing here. So I think the Fed needs to be careful here. I think they need to, at this point, take their time. They should have moved earlier, but at this point, they need to take their time, be somewhat predictable in raising these short-term rates. And as for the economy, I think it bounces back a strong second quarter, maybe 5% growth. But then, you know, we're at full employment at that point, and I expect that this economy, in the long run at full employment, will not grow by more than 2%. So we're going to slide to about 2% growth by the end of the year, one way or the other.
Jay Pawlowski, final word here.
Yeah, no, I think that's really the question. What do we look like 6 to 9 months down the road? I think the market is way too aggressive on tight pricing in 4 to 5 rate hikes. It's going to be more like 2 to 3. And I continue to stick by my view of higher than average nominal growth rates and sustained negative real rates to support risk assets. I think we do have the potential to have a stronger economy than David was just talking about as we move into 2023 and 2024. And I think that's what's on the table. And the market is not pricing that in at all. The market is pricing in a return to pre-COVID, 2% growth, 2% inflation. There's a chance for better than that. And that's where the opportunity set really lies.
Spoken like a true equity bull. Jay Pawlowski sticking with us alongside David Kelly, together with Gargi Chowdhury. There is only one name to look at in the pre-market, and it's brutal. It's ugly. Here's Abby with more.
It is truly ugly, and of course, we're talking about Netflix right now, down 21% in the pre-market, and stunning decline, extraordinary. Making it more extraordinary beyond the absolute amount is what we discussed yesterday, John. Over the last 2 months into this report, down 25%. Usually, that would mean the worst-case scenario was already priced in. But when you have a stock that's trading at a 74% premium to the comps, then slashes the first quarter subscriber outlook on top of a 50% cut in 2021, what you have on the open will be down 45% in about 2 months. And it really looks like, from a broader perspective, John, the stay-at-home trade is done.
Just unreal to see a stock, a name that big, get hit that hard in the pre-market. More from Abby a little bit later this morning. We'll catch up with Ed Ludlow on the West Coast around the opening bell as well to go through that name. Futures right now down 0.75% on the S&P. Coming up, Democrats attempting to salvage what they can of the Build Back Better agenda.
I want to find as much common ground as I can in a bipartisan way when it comes to infrastructure. But I cannot limit my vision for America to what the Republicans will agree to.
That's next. This is Bloomberg.
lot of EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Earnings season is here.
I'm looking at ratios that are jaw-dropping.
Bloomberg is fastest with the numbers and analysis.
I'm going right to return on tangible equity.
They missed on FIG trading.
They're too hot. Bloomberg, the fastest numbers and analysis you trust.
What the president calls chunks, I would hope would be a major bill going forward. It may be more limited, but it is still significant. Whatever you call it, we want it to be able to make a difference in transforming the workplace by honoring work, by respecting the fact that there are families that have to make decisions between home and work, and again, protecting the planet.
Democrats looking for another path for its Build Back Better agenda. Republican governors pushing back, condemning the party, writing in a letter the following: your administration should not attempt to push a social agenda through hard infrastructure investments and instead should consider economically sound principles that align with state priorities. Joining us now from D.C. is Bloomberg's Anne-Marie. Anne-Marie, I just got a note from Ethan Harris of Bank of America. The title of that note, Build Back Smaller.
Small.
Is that going to be the story?
Yeah, I was just reading through that note. Bank of America, Jonathan, basically expecting that massive legislation to be cut in half. So that is one of the Democratic agenda items for the start of this year, building back but smaller, which basically means there's going to be a lot of policies that are on the chopping room block because of this. So what they're going to focus on potentially is going to be child care, elder care, health care, and climate. The one thing that is going to be a big hurdle for them to try to get through, Jonathan, is the extension of the child tax credits. The other two big legislative items we should note is that the government runs out of funding in less than a month on February 18th. So you do see a lot of discussions regarding what that could look like, potentially what could be married into legislation for the government funding could be disaster relief for here in the United States, as well as substantial foreign aid. And then finally, Speaker Pelosi also talked about making sure they can get over the finish line this legislation that would combat China, a China competitive bill. And in that legislation, Jonathan, which has wide bipartisan support in both chambers, but they need to be able to merge the language of what they both voted on, would be $52 billion in grants for semiconductors. And the president will be speaking about that today around 11 a.m. with his Commerce Secretary, Gina Raimondo.
Anne-Marie, just picking up that line from Bank of America, Build Back Smaller. Here's the quote: after the collapse in negotiations on the Build Back Better Act, we now expect a fiscal package about half as large. They go on to say a smaller near-term fiscal expansion means just a 15 to 20 basis point boost to 22 GDP compared to our estimate of 50 basis points for the Build Back Better Act. Anne-Marie, I want to finish on energy. You went to the words of Gina Raimondo. I want to talk about more broadly the energy effort internationally now for this administration. They were concerned when crude broke 80 last time around. Here we are approaching 90. What's the response now?
It's going to be very challenging for the administration in this particular environment. The market is very, very tight. They've already went through their own SPR release, in which we see, which had slight impact on the market, but not enough what we're seeing now. And it's very tenuous because there is an upcoming OPEC Plus meeting, but there's two key things to keep in mind. One, you have a number of countries like Libya, like Nigeria, who aren't even making their current quotas. They can't get through their current production quotas. So to expect them to pump more is going to be incredibly difficult. Then you have the likes of Russia and this tension with Ukraine that is going to be a premium on the price due to geopolitical concerns. Also, Russia is struggling to meet their quotas, and they potentially may play politics, Jonathan, with oil and gas. We've seen them do this in the past, and you need to think about what President Putin is thinking in terms of oil and gas. Yes, he of course likes a firmer price, upwards of more than $80 a barrel for oil, but their budget in Russia is linked to an oil price of just north of $40 a barrel. So he has a wide gap to really play politics with energy right now, especially knowing that that is a massive issue for the United States in this White House.
Anne-Marie, thank you. Sorry, I'm slightly distracted. A good fund manager, a good friend of both of ours, just sent me a note about Netflix. Schitt's Creek, it's a buy. Schitt's Creek, of course, spelled differently, and you can figure that out for yourself. AMH, thank you. Good to catch up as always. My distraction on Netflix, that stock is down about 20% in the pre-market. Away from Netflix, we're talking about a Fed that's tightening policy, the prospect of that happening, and we're looking to China now and looking for completely the opposite. This is what the Chinese are apparently telling their banks on the ground. Bloomberg reporting the following. The People's Bank of China gave so-called window guidance to large state-owned lenders and regional banks in mid-January, encouraging them to extend more credit to companies and households. Back with us, Gargi Chowdhury, Jay Poloski. Jay, this has been a theme that I know you're leaning into a little bit. The Chinese and Chinese officials are going in the other direction to the Federal Reserve. How important is that, Jay?
Well, I think it's very important globally, John, because the PBOC with the Fed are the two big central banks. So one is tightening, withdrawing liquidity. The other is starting to ease and provide liquidity. And the PBOC has a ton of room to do that should they want to continue in that policy mix. Look, we are not just slightly dipping our toe in. We have a significant overweight across Chinese assets, equities, currency, bonds. We think China 2022 is a glide path year, politically focused on President Xi's third term. Policy is going to work in accordance with that objective. Omicron is, the zero COVID is a question mark, but they're moving into a dynamic clearing approach, not a true zero COVID approach. Markets have been beaten up. China had one of its worst years, one of the worst performers last year. Valuations are very compelling. Tech stocks are priced at half the valuation of U.S. tech stocks. We're seeing some migration from U.S. to China tech. KWEB was up 4 or 5% yesterday as an example. We like Asia. We wrote a piece last week called Look to the East, not just China, but also Japan. We think both markets have significant upside.
Heard Japan a few times over the last couple of weeks, that's for sure. Gargi, just looking through your note, you think barbell, value on the one side, floating rate bonds on the other, got it? Trying to work out your geographic footprint here, Gargi. How important is that diversification?
Sure. So it is, coming back to the barbell, I think it's value and quality on one side. And then for those investors that are looking at the fixed income markets with the view that inflation and interest rates are going to go up, sort of having that exposure in the shorter duration, so floating rate bonds, shorter dated tips, shorter dated corporate credit. So that makes sense. And again, looking at value and looking at the quality barbell, look, there's been a little bit of a throwing of the baby out with the bathwater. And that's when it comes to the tech sector. And I think there are parts of tech that can still do well, especially those parts that are exhibiting that quality and showing that margin resiliency. I was hearing a reporter earlier talk about the semiconductor sector and just in terms of how much is in the bill to support semiconductors. And that is an area of the market that we think makes a lot of sense. And finally, I would just say in terms of the geographic rotation, what we're seeing in ETF flows this year certainly is that move towards value, and not just value in the US, but also value in Europe. And that is something that we expect to continue, that move towards value in a world where interest rates are going to move higher. We expect that value to outperform. So that should go on to 2020.
You're going to stick with us alongside Jay Poloski, and I'm pleased to say I am just hearing back that we're trying to re-establish that connection with David Kelly of JP Morgan Asset Management. So hopefully we manage to do that around the opening bell. Guys, thank you for your patience. Coming up, the morning calls, and later, stay-at-home stocks taking a massive hit. Netflix down more than 20% in the pre-market. It's a break of 400, 399.64 in early trading. We are down more than 21%. Much more on that story. We'll go to the team on the West Coast, catch up with Ed Ludlow in about 7 minutes' time. From New York, this is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Minutes away from the opening bell in New York. Here's the price action for you. Off the lows on the Nasdaq, down about 0.8%. A different flavour to this one this morning. The bond market's firmer, yields are lower. Switch up the board, 2s, 10s and 30s. We're down 5 basis points on 10s right now to 175. It's a break of 1% on 2s. We're down 3 basis points there to 0.99%. That's the price action here, the morning calls. Let's kick things off with Wells Fargo, raising its Apple price target to 205 ahead of earnings next week, expecting positive commentary regarding the supply chain and on global demand. That stock is down about 0.5%. Citi upgrading Under Armour to a buy, the analyst highlighting an attractive valuation with notable opportunities for growth within China, up a little more than 1% there to 1872. And finally, Benchmark upgrading Netflix to a hold despite lackluster results, the analyst calling the post-earnings sell-off, quote, overcooked. Well, it's something. It's down more than 20%. Coming up, the so-called pandemic trade falling out of favour, investors moving on from the stay-at-home winners. That conversation is up next. From New York, this is Bloomberg.
When you think space, you probably think
One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
24 seconds away from the opening bell in New York. This has been a messy one this week for the Nasdaq. Down about 4.5%, pushing 5 percentage points lower. This morning we're down 0.7%. We're negative more than 100 points. On the S&P, we're down about 16. We're down a third of 1%. Let's the opening bell, switch on the board and get to the bond market. This time yields aren't higher. They are lower by 5 basis points to
Connection lost.
175. Talked a lot about this through the morning so far. As this bond market breached that limit where it starts to become self-limiting, it hits financial conditions, the equity market, that flows back into a bid. Maybe, or maybe this has just paused and there's more to come. That's the view of Bank of America. This rate shock, in their view, is only just getting started. The euro's firmer, dollar weaker, euro dollar 113.56, up 0.4% there. On crude, 84.87, we are negative by about 0.8%. The only opening price you all want, I know, it's Netflix. Have we got an opening price? I think we have, so let's get it up very quickly. We are negative 22% on Netflix this morning. It is the stock of the morning, without a doubt, down 21.6% and jumping all over the place. Let's get to Ed Ludlow for a whole lot more. Morning, Ed.
Good morning, John. That's the biggest drop, by the way, since July of 2012. Netflix, a very different company in July of 2012, the stock lowest since April of 2020 at the start of this pandemic. Several Wall Street analysts have cut their price targets on this stock, obviously. You know, the 2.5 million net subscriber adds for the first quarter in terms of what they guided was half of what the street was looking for. And executives kind of pursed a number of things to do with that. Growing competition, right? The changing macro environment, economic pain in key markets like Latin America. I think you're a big Bridgerton guy, right, John? And the second season is coming in March. So that's late in the quarter. So executives tried to spin this as being, well, the content slate is pushed out. We'll see some new subscribers come in late in the quarter, hence the downgraded outlook. But that's only half the story. Let's look at margins. Come with me into my Bloomberg terminal, because subscriber acquisitions were below what was expected, right? Margins, operating margin falls to the lowest level since 2018. And then you look at the guidance for full year 22, operating margin of 19 to 20%, but they're really impacted by currency headwinds, right? Strengthening dollar will hit revenue by in terms of $1 billion hit in 2022, but also 2 points of negative impact on the margin. This is a company that doesn't hedge, by the way, when it comes to currencies, and they get 60% of their revenue outside of the US. So there's a lot going on here to look at. And it just raises the question of the week. Is this the end for the pandemic era stay-at-home stock winners? You and I have been on this show for 18 months talking about stickiness. How sticky are these stocks? That's a 2-year chart. You can see we've given up most of the gains of the pandemic era. But stickiness doesn't seem to be the issue, John. The issue that Wall Street's pointing to is, where does growth come from when the pandemic goes away? And why have we not returned to pre-pandemic growth levels?
Bridgerton. Who invited Ed? Who watches Bridgerton? Ed, final
regret
questions.
that.
You knew you'd... Come on, buddy. You know
Sorry,
me
mate.
better than that. $200 billion name, Ed.
Yeah.
How on earth did corporate guidance and the street get so out of whack?
Yeah, it's interesting. I mean, what's so surprising about this is I've been looking at data from Paris Analytics. They look at market share. And we knew by December that you have the likes of Amazon Prime, HBO Max, Hulu, already taking significant market share from Netflix. You know, they're seeing literally a 10 percentage point drop from where they were at early in the pandemic. So we kind of saw this coming. But the other thing as well is that the economy is different, right? Some places are opening faster than others, and the sensitivity of households is changing. If you look to emerging markets like India, they kind of seem to have got their pricing wrong there, where spending power is much less. So they are having a little bit of rethink on the product as a whole.
Ed, thank you, buddy. As always, from the West Coast, a good friend of ours, Ed Ludlow. That stock is down by more than 21%. As Ed points out, if we closed here, it would be the biggest one-day loss going back to July of 2012. Tech earnings kicking off over the next week, then we'll hear from Apple. This is the line that we got from Loop Ventures. They say the following: brace yourself. These results cast a shadow on the rest of tech. Until Apple reports and we hear from the Fed, the tech market will be on edge. Back with us, Gargi Chowdhury, Jay Poloski. Jay, I want to come back to you. I want to get the view of both of you, actually. When you see a name like this get hammered the way it's getting hammered in the market this morning, Jay, is there a lesson from that, a single name story for you, or something broader?
No, I definitely think it's part of something broader, John. Look, these types of names, the thematic stuff, the ARC, have been decimated for months. They peaked back in February, almost a year ago. I think a real question, and we've touched on it before, is whether this is the beginning or the end of a bear market, not for the work from home. Work from home, I think, is over. Haven't been a fan for quite some time. I think the bigger question is, you know, we're talking about build back smaller. If we get the climate package, does that give the thematic segment of the market a lift? ARC, for example, has round-tripped completely. It now trades for roughly the same price-to-sales valuation of the NASDAQ 100 with double the revenue growth of the NASDAQ 100. So valuation, technicals, market sentiment all suggest to me that if, as I do, one believes that the growth coming out of COVID, when we get through COVID and we start to see what does the world look like, if it can be better than the pre-COVID 2 inflation, 2% growth, which I think it can be, arguably these types of names, not necessarily the Netflix, but some of the thematic, disruptive tech, innovation, climate-specific stuff, are the things that are going to be the opportunity set. And so to me, that's where I'm looking, watching ARC carefully, watching some of the thematic stuff very carefully, as well as our previous focus on value in non-U.S. equities. I think the opportunity here is to start sifting around some of these segments, some of these thematic innovation type names that have been absolutely hammered. Down 20%, John. I've seen that repeatedly for months in a number of segments of the market. This is nothing new.
Gargi, your take on that, to the same question, please.
Sure. So I think we have to look past the reopening and the stay-at-home story and looking ahead for 2022, the story is going to be about one thing, which is around margin resiliency and pricing power, and what companies are able to do that, pass on higher prices, and what companies aren't. So that's what we're going to be focusing on and really looking at those companies, those quality companies that have that pricing power. The second part is, you asked Jonathan around, is this the beginning? And I would say that, there is a huge amount of awkwardness that's going on with the Fed right now. I mean, they're still buying bonds. Then after that, they're going to raise rates. Right after that, they're going to do something with the balance sheet and start beginning the unwinding process. So I think that the market often has shown us that they don't like that type of volatility from the Fed. So while we still sort of get some of these motions in place, I think we can see a little bit of volatility in the markets. However, what we have to keep in mind, which I think the previous speaker was saying as well, is that we're looking at extremely good levels of growth. We're looking at a labor market that's incredibly strong. We're looking at wages picking up. We're also at the same time looking at a lot of cash that's still sitting on the sidelines in money market mutual funds. So the prospect here for the equity markets remain pretty strong. I mean, we're still at negative real rates, even despite the move that we've seen year till date. It's it's still negative. And compare that to the, the 2% era of positive 2% real rates. So this is not a market that that can, stay down for very long, but certainly some volatility to come in the near term.
Everything you just said is at the epicenter of Jay's call. This is what Jay's talking about. He believes that real rates will remain negative, that trend growth will be higher than you think it will be. It will be above 2% for longer than you think it will be. And for that reason, Jay still likes this equity market. We've got a ton of earnings coming up over the next week. IBM, Microsoft, Apple, all on deck. Let's get to Kaylee for more. Hey, Kaylee.
Hey, John, we'll put together Microsoft, Apple, and Tesla, and what you get is a collective near $6 trillion in market capitalization that reports over the course of next week. So this is a lot of weight, and that weight has been a big drag to the downside so far in 2022. Microsoft, for example, is down about 10% over the course of the year thus far. Tesla by about 7%, Apple by about 6%, and all said, that contributes in a big way to the decline we've seen in broader technology, with the NASDAQ down about 10 percentage points, as we know, in a technical correction. So the question is what these reports of these companies will do, not just to their trajectory, but really the trajectory of tech more broadly and the broader market. As for what the reports are expected to look like, we are expecting growth in the technology sector to slow on both the top and bottom line. For that top line revenue number, slowing from 19.2% in Q3 down to 10.4% expected in this reporting season. Then when it comes to earnings, from 42.3% down to less than 14%. And that is expected to continue to decline as we move forward through this year and the comps get a lot tougher. So it's kind of a dual challenge for these technology names. When you're faced with the prospect of slowing earnings growth, at the same time, we're seeing yields moving higher, calling into question some of those higher multiples that investors have to pay. That already has led to a major exodus of growth stocks, which are lagging value stocks by a margin of about 8 percentage points so far this year. And you can see value there in white gaining ground against growth as yields head north. So we'll see if this rotation gets reinforced by earnings or starts to turn the other direction after them, John.
Kaylee, thank you. Let's turn back to Netflix as well. This stock down by 22% now in early trading, the biggest one-day move we've seen going all the way back to July 2012. That note I mentioned is from Stifel. They call it Schitt's Creek. I think you get the pun there. They keep a buy. Here's the quote. I'm not sure if you're in the mood for fun this morning, if you're long this name. We maintain our buy rating on Netflix as we continue to view it as the best positioned asset in the space, with ample headroom to capture market share, execute on its strategic initiatives, and deliver consistent margin expansion. That's a name right now, the sub 400, 500 price target, down 22% on the day. Jay, it's a tough one. I want to talk about this with you, just the psychology of being an investor. A lot of people who come on a show like this will talk about buying the dip. Then you get a 10% correction on the NASDAQ 100, and all of a sudden buying that dip doesn't sound so easy. Jay, walk me through your approach to markets when you think about those issues, because I think for a lot of people, it's not just about the numbers, it's just about a feeling, a sentiment, a feeling that keeps them away sometimes and away too long.
Well, I think, John, you got to have a framework, you got to have a process. I've been doing this for over 30 years. The other thing that's nice to have is a wide ambit. And, my focus is global macro and multi-asset. So we can look outside the United States, and we are. We think there's tremendous opportunity in the developed ex-US markets. We can look beyond tech and beyond growth, and we have, and we've been early, and you and I know that. We've talked about this for some time. Cyclicals and value, energy, financials, not just in the US, but also in Europe and further abroad in Japan. You have the opportunity to look across assets, so not just equities, but also bonds, which have been a place for us to take a significant underweight and use that cash elsewhere. And part of the place where we put that cash is in commodities. And commodities are up 10%. And when you put the things together, it tells you with rates going higher and real rates going up, okay, so it's not an inflation fear, it's growth. With commodities going up, that's reinforcing growth. With the dollar typically weakening as the Fed tightens, significantly jumpstart flows out of the U.S. into the rest of the world. That suggests to me that we have this area of opportunity that one of the worries is, are we in like 2018, okay, where I had the same view, look outside the U.S. The Fed tightened and we got crushed and it was a mistake. Today, there are differences. What are the differences? We're starting out at a early cycle, not late cycle like we were in 2018. We also have that high nominal growth, 5 to 7%, not the 3 to 4% we had in 18. We have negative real rates, not the positive 2 that our other guest was talking about. and we have a weak dollar. So I think you can make the case through a process of this is a different outlook. We have a CapEx boom, an infrastructure boom coming down the road, not just in the U.S., but also in Europe and globally. Climate is a global issue. And I think we're setting up for an analog like the second half of the 1990s, the last CapEx boom, productivity surge-driven economy in the U.S. And the difference this time, John, it's global.
Some people think we're coming out the other side of the 1990s. Jay, we can continue that one another time. Gagi, I wanted to give you the final word. The final word, please.
I would say to your question, what type of an investor are you is one that comes to mind. So if you are looking for a day trade, yes, I think there's going to be volatilities, but hopefully most of us aren't looking for that quick day trade. And I think if you can be a little bit more patient with these markets and look at the macro, look at that growth story, look at the labor market improvement, look at so many of the other positive factors, such as the negative real rates that still accompany us, I think you're supposed to stay invested in the markets, certain sectors of the market, certainly that value and quality that we talked about earlier, and I think that is going to pan out. But if you're looking for more of the short-term gains, I think that in these volatile environments, that could be hard.
Gagi, brilliant, as always. Gagi Chowdhury there, alongside Jay Pilowsky. Netflix right now down 22% in early trading. Coming up, the US and Russia agreeing to continue talks as tensions over Ukraine simmer.
There was ever a time to test the resolve of Europe and the United States when it comes to enforcing borders and other measures. Now is that time.
That's next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
My guess is he will move in. He has to do something.
In these kind of circumstances, we have to be ready for everything.
If Moscow chooses the path of further aggression, we will impose swift and massive costs.
The Russian side is aware of our determination. I hope they also realize that the gains of cooperation outweigh the price of further confrontation.
Any use of force against Ukraine will be a severe and serious strategic mistake by Russia, and it will have severe consequences, and Russia will have to pay a high price.
It is going to be a disaster for Russia if they further invade Ukraine.
The US Secretary, Antony Blinken, and his Russian counterpart, Sergei Lavrov, emerging from meetings today with little resolve, the US pledging to continue talks.
This was not negotiation, but a candid exchange of concerns and ideas. Following the consultations that we'll have in the coming days with allies and partners, we anticipate that we will be able to share with Russia our concerns and ideas in more detail and in writing next week. And we agreed to further discussions after that.
Joining us now to discuss is Bloomberg's Maria Tadeo in Geneva, where those talks took place, and Anne-Marie down in D.C. Maria, let's just start with you. What did we learn today from both Secretary Blinken and his Russian counterpart?
Well, here's the thing, John. We did hear from both sides. They both say they will continue to talk. In some extent, that could be good news. It buys time for everyone. It also shows that an invasion into Ukraine is not imminent, particularly after the Russians said that the U.S. will present some proposals on paper next week. And potentially, there's a lot of speculation, especially on the Russian side, that we could see a meeting between Vladimir Putin and President Biden. Nonetheless, when you look at the issues, not a lot changed. You did hear from the Russian Foreign Minister Sergei Lavrov saying, we don't want to invade Ukraine, we don't want to hurt the Ukrainian people, but we do know there's 100,000 men that are stationed in the Ukrainian border and of course are ready for combat. On the other side, of course, when it comes to the United States, they were also clear their sanctions are still very much on the table. But to me, John, the bigger question here is the future of Ukraine. What Russia wants, which is a guarantee that Ukraine will never leave its sphere of influence and will not join NATO, that is something that the West simply cannot accept. So where we go from here, to me, is still just as unclear as it was this morning.
Anne-Marie, you have been in the room with both of these leaders, with Vladimir Putin in the past and again with President Biden more recently. What are you expecting and how are you expecting this to play out domestically here at home in America?
Well, speaking of being in the room with both these leaders, Jonathan, we should note that Secretary Blinken alluded to the fact that it could be on the table another summit between President Vladimir Putin and President Biden. What I expect here at home is the president is going to remain forthright in his characterization of what Russia is doing and the fact that if Russia was to invade, there will be serious consequences. And he wanted to reiterate that, looking down at a piece of paper yesterday before he went on an infrastructure event. There is one development, though, Jonathan, we should talk about it. It's a Bloomberg News story from our colleagues Nick Wadhams and Alberto Nadelli, and that is the fact that the U.S. is preparing to potentially extract American citizens and those personnel out of Ukraine. Now, while the U.S. government would likely say, well, this is prudent, given the fact that they do think that Vladimir Putin could invade Ukraine, it does certainly seem like that looks like the direction of travel. When you have the U.S. government potentially out with an announcement in a few days that they want American citizens home and out of Ukraine and out of harm's way.
The team coverage continues here on Bloomberg TV and on Bloomberg Radio. Anne-Marie Hordern down in Washington, D.C. Maria Tadeo over in Geneva, the scene of these talks today between Secretary Blinken and Foreign Minister Lavrov. The story of the moment in the bond market, yields are lower by about 5 basis points on 10s to 175. In the equity market, we are lower, much lower. Let's get you some sector price action with Kriti Gupta.
Morning, John. We have to talk about simply the growth defensive positioning that you're seeing in the IMAP this morning. A lot of this has to do with those consumer staples really leading the pack when it comes to really what's gaining. Utilities as well are in the green. If you want to look at what's the downside mover, is those going to be energy and communication services. So your big tech and your energy both on the same idea. They're both dropping lower and lower. The idea here is that you're actually seeing a broader decline when both of those sectors really lag the broader market. If you actually look at what this is doing to those stay-at-home stocks, We know Netflix is going to be the major story, the biggest decline since 2014. Back then, the CEO had actually said they had overestimated growth, and simply that story is what is weighing on that stay-at-home index once again. It's not just today, John. Netflix, Roku, some of those other stay-at-home names, well, they've been weighing on the index broadly for about 2 to 3 months now.
Unbelievable stuff in this equity market over the last couple of days, the last few weeks for that matter. Critty, thank you. Netflix is down. It's down hard. This equity market on the S&P 500 down about 0.6%. The Nasdaq is down about 1 full percentage point. Coming up next on this program, your trading diary from New York City, the guide to the weekend coming right up, and into next week, a Federal Reserve decision, a Chairman Powell news conference just around the corner. From New York, this is Bloomberg.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We're taking some more weight off the Nasdaq. We're down about 1 full percentage point, and the S&P coming into 2022. The lowest price target on the S&P 500, 4,400. That was from Morgan Stanley and Mike Wilson. Right now, 44.52. The single name you want to look at this morning is Netflix. It's down hard, a big miss. We're down 23%, just a massive move lower. But this time, yields aren't pushing higher. They're coming in. Have we reached that point where the bond market starts to inflate the other way? A self-limiting sell-off, maybe. Yields coming back in, or maybe this is just a pause in a trend we've seen so far. A pause and a trend that will resume. Down 5 basis points on 10s to 175. On 2s, back below 1%, just a little bit. That's the price action. Let's get to the trading diary. The president discussing plans for the supply chain at 11 Eastern. Moving to next week, PMIs from the US on Monday. A Fed rate decision and Chairman Powell news conference on Wednesday. And finally, tech earnings coming throughout the week. Apple rounding it all out on Thursday. From New York City, catch me at 1 p.m. Eastern time for Bloomberg Real Yield. A ton to talk about in this bond market. For the rest of you, enjoy your weekend. This was the countdown to the open. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines. because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion.